There we go. All right. We are live. Everything looking good. Let me know in the comments. Everything is coming through loud and clear. Appears to be in order on my end. No thanks to YouTube. All right, great. Let's go ahead and get this stream started. Welcome back to the channel, Crypto Trend Trader, with our Friday morning market wrap up. It is 6/17/2022. 11 a.m. Eastern Standard Time. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, so just like we saw last time with the Fed meeting, I basically saw a quick little pop up in the markets, followed by a move straight back down. And once again, we have reset the days without new lows count. So we are officially at 0. So it's been 0 days since we put in a new low. So as far as I'm concerned, everything continuing to, well, not everything, but 99.9% of everything continuing to trend to the downside. So I'm not seeing any indication of long or medium term bullishness in the market. We do see some potential for temporary exhaustion for a counter trend trade to the upside. Obviously, the last one did not work out. Fortunately, it moved in our direction prior to reversing. So, like always, once the trade starts to move in our direction, we'll move our stop loss to break even. And then if we do get stopped out, basically are in a free trade as, you know, we just get back out at our break even price. Since then, we have broken back down, revisited the lows on crypto, Bitcoin, Ethereum, put in new lows on a daily close. So again, just nothing looking bullish at this point in time. That being said, let's jump right in and take a look at some of these charts. All right, so TNX obviously had a nice pop to the upside. We saw a little bit of a pullback. We're seeing just a slight little bit of continuation, basically coming back down and filling that gap at 3.16. Still looks okay for now. Obviously, at some key levels, we are watching these charts for potential bearish divergence to develop. We have 2 red histograms already on the TDMACD. And then also, if we go to the Jewel Thief here as well, we will see our previous high is basically lines up perfectly with the high from the 22nd. And again, obviously, price was much lower at the time. So we do need to watch for daily bearish divergence. Oftentimes, we will see multiple drives of bearish divergence. Arguably, you know, we have 1 or 2 drives already, so we'll see how it plays out. Long term, still very bullish. Shorter terms, would not be surprised to see a little weakness in the TNX. So obviously, countering that with the TLT, we finally saw a little pop to the upside after new lows. And again, we were looking at this bullish divergence taking place. We have new lows on price action, but higher lows on the indicator oscillator. Again, telling us that there's signs of exhaustion. More likely than not, we would come back up and retest key levels like 112 or possibly like 116. We'll have to kind of play it by ear as we go. Definitely seeing some potential levels for short-term reversals. And again, it's very important that we watch all these things and look for confluence, not only on a single chart, but amongst like assets, asset classes. So as we see multiple assets or asset classes approaching key support levels or hanging out around those support levels, we start to see exhaustion indication, you know, bullish divergence taking place, you know, loss of momentum, etc. More likely than not, once everything is around a key support level, we're likely to get, you know, a counter trend bounce. You know, we know that's going to probably underperform because of counter trend, but we're paying attention to. Next, we have the VIX. Obviously, we got that nice pop up. We retested the heart line of the VIX of our ascending channel. We have a resistance here in red. We hit that a couple times as well. So we know this is a key resistance area. We have the heart line in orange of the ascending channel. We have the descending resistance in red, and we're right there at that area. So, you know, more likely than not, what's going to happen, we'll probably continue to trade inside of this sort of like triangle / range. So it wouldn't be surprising to see us come back down to the bottom of the range, hit the 200 exponential and simple, kind of work out this little tightening area. And then eventually we do expect a break to the upside. You know, we'll have to wait and see what it looks like at the time, but we are building up momentum, hard buy signal coming out of the bearish control zone, a bunch of green histograms, blue slope line above the 0 line. 821 across the upside. We bounced at 200 exponential and simple. So everything looking bullish on the VIX for now. So if it looks bullish, it means we would would and should expect continued or heightened volatility. So next we have Dow Jones. Dow Jones has put in new lows. We're very, very, very close to visiting our key level of support, which is the pre-Rona dump. Obviously, that is just below where we're at right now. Arguably, we've already basically touched it. So we did make it down to our next target, obviously our blue box area. We have this kind of weak descending support line right here. We have this moderately, reliable descending support line right here. You could argue that this could be placed a lot of different ways. There's not really like a clear and concise way, in my opinion, to kind of put this up, but something to that effect essentially. But the most important thing is, we're in between the 236 and the 382. Those are obviously key fib targets. But again, we would expect the pre-Rona dump high to act as support as we come down to it, as that was clearly resistance on the way up. And we did also see we actually gapped up from that level. So it wouldn't be unrealistic, just to kind of hypothesize about a path forward from this point in time. So if we're essentially, right here in price action, and this is our key support level, and then below us is the 382, our next support level, and then we have a clear gap that we left behind here on November of 2020. Not that hard to believe that if we come all the way back down to the support level where we're at right now, the pre-Rona dump, that we could go a couple dollars lower and hit the 382 and also fill that gap. So that's what I'm paying attention to right now. So if you ask me like, hey, you got to bet on one of two outcomes. We either bounce right now and go back to the upside, or we continue lower, down to that 382, fill the gap, and then, continue to the upside or bounce to the upside, etc. I would say we're more likely at this point in time to come down lower, fill that gap. So while I'm paying attention to the key level we're at right now, below 30K, and that was very obviously our target, for some time now, no surprise. The markets are playing out very, very predictably. They are literally laying down a trail of popcorn for us to follow, just leaving those breadcrumbs for us. And, arguably, it's not even like they're leaving breadcrumbs at this point in time. I mean, they're full on, they're orchestrating their moves, to the up and downside. It's very, very clear what's taking place. It's very obvious to anyone that has grips with these markets, what we're seeing right now. I'm not sure how so many people are still confused, but hey, we're doing what's working, and we're going to keep doing it because it's going to keep working. So that being said, looks like we're going to come back down here to the 382 on the Dow. So my target over the next week, month, couple months, whatever, is going to be that 28,315. Obviously, we don't know how long it's going to take to get there. It could go there today by the end of the day. It could go there 2 months from now after a bounce and then retrace deeper. But as of now, we know we're putting in consistently lower highs and lower lows. We know we are below the 200 exponential and simple, and they're both sloped to the downside. Very, very bearish. We're in a very bearish situation right now. We have new lows on the histogram. We also have all red histograms. We have new lows on the stochastics. And the knife is fairly aggressively pushing to the downside, but not so powerfully, that we're just going to assume that that's the end of it. We see one little stab right here, but we got much, much lower on the previous stab. So, while it's possible that we print some form of divergence on that, I think it's much more likely that we're just in the middle of a move. And now in hindsight we were talking about the bearish reset for literally week after week after week about how there's a bearish reset taking place in crypto, in stocks, and all these different asset classes. And now that we've seen it play out, we can look back in hindsight and say, well, we were wrong. Oh, no, I'm sorry. We were 100% right. We literally nailed it. So yeah, there was actually bearish, reset taking place. That is something I made up. A bearish reset is not something that you're going to find in a book, or a bullish reset. It's not the type of thing that you're going to read about somewhere, because I made it up. It's just like Slinky Theory. If you go out and try to buy a book on Slinky Theory and how it works, you're not going to find it because I made it up live on stream. So that being said, we know Slinky Theory in full effect. We know we're basically seeing a bearish reset take place, and now this is only just the beginning of the move that follows. So that being said, am I bullish right now on the Dow Jones? No, of course not. Not while we're putting in new lows on a daily. We're about to close our weekly as well. We do have a long weekend for, whatever, woke holiday or whatever we're celebrating in the United States. So Monday is off. So no markets on Monday, obviously, for woke day or whatever they want to call it. And that being said, if we close a week Friday close, which it sure looks like we're doing right now here on the weekly, we're very close to closing not only a massive new low, and, big, thick, juicy red candle. We are at support 200 exponential, very close to 200 simple. But again, this looks very, very bearish. Very bearish. I mean, we're at support, so that's good. We would expect the market to buy up support, and the support also lines up with that previous high. We know also we have a gap slightly lower. So we have quite a bit of confluence around this level for at least some sort of temporary support. But at the same time, we're not seeing any signs of the market wanting to reverse. And if we go into Friday, what I would expect to happen, look, it's Friday, you know, a couple hours towards the end of the close, we're probably going to see all of a sudden some buying pressure coming in and people trying to buy up the market. And, this is going to be the reversal. This is the bottom. We're at support. Next week, we're going to pump. We're going to have a few weeks worth of pump. Maybe that's it. That's the bottom for really bullish people, regardless of what happens. If we get a weak close on the weekly, we would expect continuation the following week, as we've seen, week after week after week. Whenever we close at the lows or get a weak close on the weekly, put in new lows, we expect continuation as we're in the middle of a trend. So that's what I would expect. Now, is it possible we get a short-term bounce off these key levels? I definitely think so, but we don't know. It could be later in the day today as we go to close. It could be, sometime next week, turnaround Tuesday. It could be, weeks from now. We really don't know, but we know that we're starting to reach key levels, at least on the Dow Jones. So we're definitely paying attention to that. But we're not seeing any signs of any type of long, medium, or short-term bottom yet. Now, there's potential for a potential counter-trend trade, short-term bottom at this time. But, again, we have to just wait for the opportunity. Next, we have SPY. So the S&P, the old spiders. Again, bearish control zone, all red histograms, new lows, obviously in a bear market. We saw that move down we obviously were already at the 236. So we saw the breakdown back to the bottom of our sort of like descending channel / wedge type deal we got going on. We're just off the 382 Fibonacci internal retracement, which would be around 355. And then also slightly below that as well, we have the pre-Rona dump level. So we can kind of compare that to how it looks on the Dow Jones and get a better idea. We know also that this long-term ascending channel support is right down here around the 0.5. And depending on how long it takes to get there, again, we see a cluster of confluence support around that level that we would expect to get some powerful bounces off of. So the truth is, or we come back down to the 382 and just hit that and bounce? Well, no, we see the 236 didn't trade that technically. It broke down through it, pushed back up above it, broke down through it again. So I think it's more likely that we're going to see some strong support at like that 339 level than at the 382, which is closer to like 355. So, but that is obviously key areas to watch. And again, going into our weekly close, we can kind of look at this weekly chart here and see it looks absolutely horrendous. And people are like, yeah, but there's a gap to the upside. We got to come back and fill the gap to the upside. So don't get bearish now because there's a gap to the upside. Sure, okay, so we will fill the gap to the upside. One day. One day we will. Is it going to be a week from now? Or is it going to be 9 years from now? I don't know. I mean, but I would expect eventually the S&P puts in a new all-time high. So I would say eventually, yes, correct. We do fill the gap. We will fill the gap to the upside eventually. Now, arguably, we already tried to come up here and fill the gap. I mean, we gapped down right here. We pushed up and filled the majority of the gap. So we basically have a gap between 384 and 389. So we have like a $5 gap. Sure, maybe we come back up and fill it. I mean, we're at some key support levels. Wouldn't be that crazy to think that, let's just assume we continue to sell off and we hit our target down here. Not that crazy to think that we could see a 15% move to the upside and fill that gap off of key support levels. But let's just keep in mind that, at the time, we are currently, if we got that move, we would be down 29%, and that would be a key support level. And then if we bounced up, we would still be down 19% off that level. So not crazy to think that after the pressure to the downside, we could see a decent little pop, something like this to the upside. But again, we would expect the trend to continue, just selling off because there's no sign of strength whatsoever. Again, we're at very key support, 200 exponential, slightly lower. We have the 200 simple. We have our Fibonacci's. We have the pre-Rona dump. So we see some very, very important things here. But the fact of the matter, the most important thing to pay attention to is we fully round-tripped. We round-tripped. We literally round-tripped. So this was before everything went down. The world went into this crazy time that we're in right now. Obviously we melted down. We had record levels of, economic, monetary and fiscal stimulus, $10 trillion pumped into the economy very, very quickly. took us up to, new all-time highs. And then where are we at again? We're right back down to where we were. So now we have record levels of debt, devaluation of currencies around the world, ridiculous levels of poverty, uncertainty, economic and, fiscal instability, record high mortgage rates, record high house prices, unaffordable, issues going on all over the world. So we have all these things going on, and now we're right back where we started at. So how well did this work? It worked great, right? It worked great. It would be the equivalence of, getting shot in the head with a bullet, and you're about to die, and, right before you die, you smoke some PCP, and then you're able to keep functioning for a little bit. You didn't fix the bullet hole in your head. You're not going to not die now. You didn't save your life or preserve your existence, on Earth. No, I mean, but you'll last a little bit longer, while the PCP, basically like stops the pain from kicking in, whatever. So, as an example, if we don't ever actually fix the problem, if we don't make any actual like improvements, what would we expect to happen? Well, I mean, nothing. If you get high and you have a shitty life before you get high, and you have bills and, all kinds of issues, and, your house is getting repossessed, or you're getting thrown out of your apartment, whatever the situation is, you got credit card bills stacking up, and then you smoke some crack, and you're like, oh man, I feel so much better now. I forgot all about all my problems, whatever. Well, eventually you're not high anymore. You come back down off the crack and you still have all the same problems. That is the economy right now. The economy is a crackhead addicted to, free and easy money and not fixing any of the problems. So now when I hear administrations, when I hear, politicians all over the world talking about, oh, we need to start spending money, capex on, oil and build refineries, and we need to start producing more. We need to, build up our infrastructure. We need better roads and bridges. We need this, that, and the other. Everything literally costs the most it's ever cost in existence. Commodities, labor, every kind of input cost you could possibly have, like fuel costs, everything is at record highs right now. And now these retard governments want to start spending a bunch of money all over the world. Now they want all these businesses that have to make profits and like return value to shareholders to start making capital expenditures while everything's at record highs. And you literally have been telling, energy industry for years that, they're going to go out of business, that they're trash, and you're transitioning away from them, and you're going to shut them down and make it so expensive for them to operate that you're going to bankrupt them? Sure, okay. So we're making great decisions, I think, is probably, the synopsis for, that little rant right there. So that being said, basically we have a crackhead economy globally. We have retards at the helm, and, the Titanic is sinking right now. So not to be too negative or anything like that, it's going to present some amazing opportunities. But I don't see anything that's telling me all of a sudden we're going to see some big reversal and all of a sudden it's gravy again. If anything, I see the opposite. I see the crackhead, just got hit by a car and now he's coming down. And not only does he have all the problems he had before, but now he got hit by a car. So he's got some broken ribs, maybe some internal bleeding, and he's got crack on him. So when the police, paramedics show up, probably going to go to jail for that. So as far as I'm concerned, we're just compounding our problems, over and over again. So extremely weak on the S&P. We are at key levels. Obviously, that was one of our key targets. 200 simple is another one. We have a bunch of targets on the way. We're full on seeing, step down slinky theory in full effect. No surprises here whatsoever. No surprises here whatsoever. And I think that this is probably the time when you should start reevaluating where you're getting your information from. So, do you have YouTube influencers, obviously other than this channel, that you watch? Do you watch CNBC? Are you getting your information from the Wall Street Journal? Do you have a buddy on Facebook that posts up, crypto tips periodically or talks about things like the Federal Reserve and they sound credible? Start looking at those people. Start looking at where you're getting your information from, and then start looking at what those people were predicting, anticipating, what they were telling you. Are they using technicals? Are they using fundamentals? Did they predict the crash in the stock market? Did they predict the crash in crypto? Do they have some sort of definable method that they're using to anticipate this? Or is it just like we've said, where everything in all these markets, the major index is going to be down over 20%, and then all of a sudden everybody's going to be saying, well, I guess we're in a bear market now, but too late to de-risk. You don't want to sell once we're down 20%, even if we go down another 10%. I mean, How are you going to know when to get back in? I mean, there's lots of people that are still sitting out from 2008 because they never got back in, blah, 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 blah. Okay, so start reevaluating where you're getting your info from. Who are your crypto influencers? Who are your stock market influences? Who is teaching you? Who's giving you valuable information? Because I think that you'll probably find that the majority of the people that you're listening to or that you're giving credibility to, the majority of those people probably have been wrong about just about everything. They probably have no idea, and they're not serving you much purpose either. So if you're not learning from someone, and if they're not providing valuable information, that helps you to become more profitable, whether it's momentum in markets, trade setups, whatever it is, I would start legitimately reevaluating whether those people or those influencers are positive or negative influence on your life. Because if they're just making you feel good, but you feel good while you're losing all your money, that's not what you want. You don't want someone that is telling you crypto's bullish and there's so much fundamentals and everything's gravy and crypto's going to the moon while crypto is crashing. And then afterwards they're like, well, I mean, in hindsight, yeah, that probably was the top. I did say that eventually we're going to top out. So, I did say that. Start reevaluating where you're getting your information from. We've talked about like this misinformation or disinformation taking place in society right now. And I think financially, the worst possible thing that you can have in your life is misinformation or disinformation in these markets, or even just blatant distractions. If you got somebody that puts out a video every single day and you get excited to see it, and then you watch that video and you're not really getting any value from it, maybe it just makes you feel good or makes you complacent, I would say probably cut those people out of your life. You want to be like, a savage living in the woods with heightened reflexes. Every time you hear a stick break, you want to turn and grab your spear and expect that there is a threat waiting for you. Instead, we've been lulled to sleep by these markets, by these, influencers or whatnot, where everybody is just like, well, we know over a long enough time frame, the Dow Jones has never put in a negative, gain on a long enough time frame. So if you just bought and hold the Dow Jones and you wait at least 12 years, you'll never be negative. If you just bought crypto, Michael Saylor comes out, crypto is the best investment you could have ever made. Okay, he's down 30-something% on his crypto investment. So probably not. If you lost 30-something% on your crypto investment, it's probably not the best investment you could have made. Could have just held cash. Oh, but they're inflating away the cash. Sure. And so even if you say inflation right now is 20%, which is probably not. Everybody has their own little basket of inflation or whatever. But let's just say it's 20%. You're still better off than losing 30%. But that's not the case. As a matter of fact, if you were holding cash, especially US dollars, over the last, year plus, chances are you could literally pick anything you want and you could get it at a 10% discount, 20%, 30%, 50%. You could buy some of these trash bag, garbage, crap, altcoins and stocks at 90+% discounts. So everybody's saying, oh, record cash positions, cash is trash, Ray Dalio's the man, don't hold cash. It's every day it's getting chipped away and you just don't know it and blah, 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 blah. Well, who did better? The guy who's holding a bunch of cash now and has an option on literally anything they want to buy, or somebody that just took, 20, 30, 90% drawdowns in the market, your Ray Dalios, your Kathy Woods. I would say probably the cash person. So, that's my rant for today. If whoever you're listening to is not providing positivity and value in your life, I would consider cutting them out. Because if they're not providing positivity, if they're not creating value, they're probably just wasting your time, destroying value, or lulling you into a false sense of security, which is exactly what we expected. And I've been predicting all this. And, honestly, I've been right. I would say, honestly, realistically, the number one thing that I got wrong about everything that's taken place over the last couple of years, the number one thing that I was wrong about, and I'll admit it, that's fine. While I did think that there was going to be inflation, I did anticipate inflation initially, I was wrong about how long it lasted for sure. I was not expecting this many horrible, horrendous policy mistakes around the world to, basically compound this issue as bad as it is. So I do admit I was wrong, but we were still positioned, beneficially for it. We've still capitalized on it. I mean, there's very little we could have done differently, that would have changed the position as far as duration over, direction, if that makes sense. So I'm still very, obviously been expecting inflation. Now, again, sometimes I'll admit it, I'm out of touch sometimes. I'm not in touch with inflation the same way that some people are. I live well below my means and am financially secure. And to tell you the truth, I don't experience inflation the same way that most people do. If you own your house, if you own your car, that's two of the biggest parts of inflation. I'm a minimalist as far as, energy, gas, all that kind of stuff. I have an electric vehicle, so I get it. I get it. You know what I mean? But I also have big diesel trucks too. So, I mean, I get where people are coming from. I understand people are under pressure. But, I admit that I was wrong about the duration of the inflation. Now, medium term, I do think we go into a deflationary spiral as we go into recession or depression. And then I think we see inflation pop back up over the next decade, and this constant war of volatility between inflation and deflation. But macro, obviously, the majority of the forces, macro, are deflationary. And that's why the Fed has to create, expansion of the money supply. Because if you don't have that take place, while you have more population, more demand, the world is getting bigger, obviously. You have more people or more demand chasing less money or less goods, so to speak. So obviously, you can't have that. You need to have a constant expansion of the money supply, or else the value of the money goes up, and then it makes it so that it's unattainable because it kills velocity of money. So it's very, very important that you understand the macro factors. And we know for sure that while we're gaining people in the world, we're gaining people at a slower rate. And the majority of our, I don't want to say rule against first world versus third world type situations, but let's be real. More modernized Western society, first world countries and everything like that, historically and, accurately to date, see declining population and, not just childbirth, but, lots of other factors as well. So part of our system is built on the fact that we're just always going to have more demand and more people, and that's obviously how you grow a business or, a population, etc. So that being said, there's macro deflationary forces like population and technology and various other things as well that we're constantly at war with. Even during this inflation, we're constantly at war with these same things. So it is important, to admit when you're wrong about stuff, but it's also important to recognize, what kind of track record people have, and then make sure that you're watching, following, pay attention to the correct people. Because if somebody's funny and they're fun and they're enjoyable and they talk about the stuff and they tell you what you want to hear, that's cool. It's good for your mental health. It's fun. It's entertainment. But if they're not legitimately helping you, if they're not being right about a lot of this stuff, be careful that they're not diluting, the legitimate information and in the long run costing you, knowledge or money. So that being said, we got the NASDAQ next. Obviously, NASDAQ continuing to melt down, new lows again, completely atrocious looking chart right here. If we switch over to the weekly, we take a look at our key levels. We are obviously at our green box area. This was our target to downside. We have essentially made it all the way to 200 simple. 200 exponential already has a negative slope. We saw that right here. We broke down from it. We still rallied. So obviously that was the Rona dump right here. Does not mean, and we've been calling for how long for a retest of a 200 exponential on simple. Got it. So another one we nailed. Obviously now, you can step in and buy lots of these NASDAQ tech stocks with no earnings, for 90+% off, cryptos, etc. Even the index itself, from 16,150 down to 10,700. I mean, how pathetic is that? Imagine just being some little, hodler that just held down through 34% drop. I mean, God, at what point in time do you have some sort of method, information, technique, strategy that's going to prevent you from losing 35%? I would say just use the 821 cross. I would say just use, the TJD master, because it's blatantly obvious right here. Oh, better get out of this trade so I don't lose another 30-something% of my money. Oh, glad I did that. It's easy as pie. So at support, is this a buying opportunity? I would say it's definitely a buying opportunity short term. We'll have to see what happens there. We're going to look for key exhaustion. We're going to look for confluence, between our key fibs and whatnot, our previous all-time high before the Rona dump, etc. And look for a bottom somewhere around here. And again, the most important thing is not only confluence just on this chart, but between all the major indexes. Because we're not going to see the NASDAQ, bounce and start just aggressively moving to the upside while Dow Jones and S&P are selling off. We're not going to see the Russell just all of a sudden going to new all-time highs while, the NASDAQ is getting wrecked. It's just not going to happen. So very important to watch these major indices. Next, we have the Ruddy, the old Russell 2000, breaking down. We have not only lost our 2020 highs, but we're actually below our 2018 highs. So, if you invested in the Russell sometime along the way, maybe you're in profit if you bought down here. Maybe you're upside down if you bought right here. But the fact of the matter is we're basically around, the middle of the range. We're equal distance from the top as we are from the bottom at this point in time. Maybe slightly less low. We see the 50% is a little bit lower at like 1538, but we're well on our way. We broke down from the pre-Rona dump. We have our next 0.5 fib level is at the 1544, so that's what we're paying attention to. Obviously, the Russell is trash. We talked about this key area here and how long we oscillated sideways for and how we would expect this massive area to act as support and this to basically just be a slow grind around these levels. But very viable to think that we can make it as low as the 618. Still very early to tell, but I would not be surprised, obviously, if that develops in time. That being said, when we look at our weekly chart right here, not only have we lost the 200 exponential, not only have we lost the 200 simple, but now we have a negative slope on the 200 exponential and simple. They have both flipped red and pink respectively, and we see a capitulation candle breakdown from that point, and that was this week's candle. So when it's all said and done, we look back at this chart right here, and let's just see how many other times that has happened to us. Well, here we crossed the 200 exponential negative. The 200 simple went negative for a minute, and that was near the bottom, and then we, V-bottom from there. We did not cross the 200 simple negative here. We did not cross the 200 simple negative here. Here we were breaking above it, finding support. So we broke out of the bear market around this level, arguably once both of them flipped blue at the same time. So somewhere around in this cluster. Prior to that, the last time we actually saw a sustained bear market on a weekly time frame was the 2008 bear market. And from when we broke down below the 200 exponential and simple on the weekly and confirmed a bear market, that was in September of 2008. When we put in our actual bottom was in March of 2009. And then from that September 2008 level until we broke through and put in new all-time highs, we're talking about November 2010. So not unrealistic to think that we could go into a bearish, weekly bear market and take multiple years to ever even get back to those levels. And even once we do, that it might take us another, long extended period before we get back to those new all-time highs. So, in many ways, you gotta be very, very careful inside these markets. And then just for, reference, from that breakdown, from the 200 exponential and simple flipping bearish and the beginning of a weekly bear trend, bear market, confirmation, 51% more to the downside. So does the Russell have to crash 51% from where we're at right now? Absolutely not. Is there a high probability that we crash from where we're at right now? Absolutely is. Right now, if you're in these markets, if you're in the Russell, which, none of you are because you're not brain dead. So if you were one of the people that's in the Russell, it's very clear to you right now, like, hey, if we lose this level right now, if we don't reclaim the 200 exponential and simple at like 1836, we will go into a bear market. So right now, we're in a bear market or approaching a bear market or confirming into a bear market. Nothing has to happen for this chart to be bearish or to get more bearish. Nothing has to happen. We literally could just go sideways. This could just turn into just a sideways every day, nothing happens, and we just open and close at the same spot, and we just print daily candle after daily candle after daily candle sideways, or weekly in this case. And nothing happens, we're bearish, we're still bearish. And the chart just continues to just look worse because we're consolidating below, the 200 exponential and simple moving average. So what we're paying attention to is not what doesn't need to happen for us to be bearish. We're paying attention to what needs to happen for us to switch bullish. So for us to actually be bullish on the Russell again, we 100% have to start closing back above 1836. So that's about $200 to the upside, roughly a 13% move to the upside. So that being said, that's what we're paying attention to. So it's not about like, hey, when do we want to stop being bearish? It's more about what has to happen for us to start being bullish. And right now, all the resistance is above our head. So until we get above those resistances, we can't even begin to look at the Russell, as an opportunity. And when I hear these moronic people literally quoting statistics about how these small cap trash companies in indexes like the Russell outperform coming out of, similar periods of time that we have right now or throughout recessions, etc. I mean, those people are morons. They're morons. I mean, nobody's looking back and saying, well, in the 1940s, this happened, so we're going to use that information. In the 1980s, this happened. No, they're using information from, 2008, 2000. They're cherry picking, they have recency bias. These markets look like trash, okay? And obviously, it's not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. I'm not telling you, hey, all of a sudden, sell out of your 401k. You have to make your own decision. But the fact of the matter is right now, what point in time do we de-risk? I mean, if it's not once we're in a bear market based on 200 exponential and simple, is it once we're down 20% and then you want to sell? Is it once we're down 40%, 50%? Is it, when Jim Cramer says to? I mean, I don't know. You have to figure out your own method. But if you don't have a legitimate method for how you're going to determine a bear or a bull market, how you're going to determine, a bull trend or a bear trend, if you don't have a way that you're going to find support or look for confluence or divergence, or you need to create your own trading plan. You need to create your own method. Otherwise, it's just madness. If you don't do anything consistently, how are you ever going to know if it works? So that being said, let's move on to our sectors of the economy. Industrial hit our support level, so we made it there. Didn't take nearly as long as I thought it was going to. Obviously, at key support between the 236 and the 382 at that previous high. Looks pretty weak right now. So if you want to look at what's the state of the overall, economy and, the ambitiousness of, industrial production, whatnot, I would say it looks bad right now. So doesn't look good. So XLP, we have our consumer staples. Again, we broke down from the 236. We are actually at the bottom of that channel consolidation right here, just off of the 382. And then obviously we have the pre-Rona dump, in the yellow line right here. So paying close attention to that level as well. But it looks like we're headed down to like 66.38, maybe 64.87, somewhere around there. Consumer staples, not looking good right now. Confirming into a bear market for the first time now. So we have basically broke down. We get the reversion to the mean retest, acts as resistance. We break to the downside. New lows below the 200 exponential and simple with a negative slope. Very much in a bear market at some key support levels. But again, looks like trash. XLF, so financial sector, again, complete trash. We broke down to our next target, key support level to the downside in yellow, the pre-Rona highs right there. Obviously, key resistance / support. We would expect it to act as support now that we are at that level, but we do have slightly lower the 382 at about $30. But essentially, we're hitting targets. We're hitting a lot of these targets, and that's what we want to see. If we're going to look for some sort of bounce to the upside, whether we play that like bullishly for a scalp, or if we're looking for, to sell the rip when it bounces up, we're going to sell into resistance, open short positions, hedge ourselves, sell off spot positions, etc. That opportunity looks like it's getting ready to present itself in the future. But in no way do I get bullish on these markets by any means. I mean, they look horrendous. XLRE. So we're seeing real estate has had a aggressive breakdown from those key levels over the last few days. No surprise here, obviously. We have lost our 2020 highs. And again, what are the prices right now for real estate compared to, February of 2020? Most real estate is up somewhere between 20 and 80%, on average, about 50% over the last couple of years. And, here we are, fully round tripped and then some. So, what's acting with a lag? An efficient market with liquidity that can be traded on a regular basis, or the housing market? Well, I would say probably the efficient liquid market, not the housing market. So I would fully expect disgusting moves in the housing market. I live in a very popular area for people to relocate to. So our housing market's still fairly strong, and we're already starting to see some weakness show up in the markets down here. But I'm not going to lie. I mean, the prices are through the roof. You can literally go back and look at, a lot of these houses, and, there's houses that sold in 2018 that now have recently sold in the last year or two for, no joke, I kid you not, 3 and 4 times as much. So we're talking about a house that was $100,000 in 2018, selling for $300,000 and $400,000 right now. We're talking about $1 million houses selling for $5 million in my area right now. So, when it's all said and done, obviously, the housing market extremely over exuberant, extremely over exuberant. And, commercial real estate, trash. I mean, how is retail doing right now? Ha! People are like, yeah, Biden, how many new businesses we created, and the minorities started their own businesses, and record new jobs being created, and blah blah blah. Well, how many businesses closed down? So if we had 1,000 businesses closed down because of what the government did or because of whatever reasons, health scares, etc., and then 100 businesses open back up, you're not like, oh my God, we just created 100 businesses, the economy's booming. We're net negative 900. We're down. We have 90% less businesses. So that's not good. That's not what our economy boom looks like. Retail stores are in arguably some of the worst shape they've ever been in. And now I don't know about you, but we're definitely seeing those gluts of inventory that we've been discussing. People were ordering and double ordering and triple ordering. And then finally, some of that pressure alleviates. All of it's here. And now the demand is going away and the supply is exponentially large. So again, we're talking about that forever volatility between inflation and deflation, and I would fully 100% expect massive volatility in retail. For the last couple of years, you couldn't get a sale on, stuff that you would normally always get on sale. Boxes of, whatever you would normally get go from having 20% more for free to literally having less for the same price or more. And now all of a sudden we're seeing these massive inventory buildups. And, if you've ever run a business before, the efficiency of your inventory and supply chain and allocation of assets is extremely important. If you have a bunch of money tied up in, inventory that's just sitting around, it not only does it cost you money because you don't have that money to put somewhere else to put it to work, it costs you capital, also it's expensive to store stuff. And once you run out of room, then you got to store it somewhere else. And then if it's sitting somewhere or storing somewhere, there's always a possibility that damage occurs, or you can't find it when you need it, or, maybe you ordered a bunch of Christmas toys and they got here, but it was after Christmas. So what, you're going to now either sell them massively discounted or store them till next Christmas. I mean, there's just so many factors right now. And I think we're going to see massive sales taking place first on retail and online retail as well. And then we're going to start to see it taking place in a lot of these asset classes that ran up. Now, does that mean they're going to be? You maybe aren't going to be able to buy a car for what you bought it for in 2017. You might not be able to buy a house for what you bought it for in 2017. But if we go down from where we're at right now, 30%, 25%, 50% on a lot of these things, half off sales, buy one, get one free, cars getting marked back down to regular value, as some of these supply chain issues alleviate, we're going to see things like the average new car value drop substantially. People are making a big deal out of it because they're like, oh, a new car used to be on average $30,000 and now it's $45,000. Well, the reason that we're seeing this skew in the dynamics of new cars is because if you are a manufacturer or dealership or whatever, and you have the option between building a base model, let's just say, Ford F-150, something popular. If you build a base model one and you could sell that for $30,000, or you could build the premium one with the bigger engine and all the electronics and the heated seats and all the little comfy stuff like that and the backup cam and everything, and you sell that one for $45,000, and you have the choice between making one or the other, which one are you going to make? Which one are you going to sell? You're going to sell the expensive one. So a lot of these distortions that we're seeing right now in prices are exactly that. They're distortions. It doesn't just mean from here on out a new car is going to cost an average of $45,000 and we just jumped up 50% in the last couple of years. No. As the semiconductor issues alleviate, as the supply chain issues alleviate, as the demand, the ridiculous exuberance and free money starts to dry up, as the Fed sucks liquidity out of the system, we will see those things come back down first, to fair value, and then eventually to undervalue. And then that's where we'll look for our opportunities, to buy up some of these things. So sure, it sucks if somebody else's new car gets repoed or their house gets foreclosed on. But you know what? If they made bad decisions, I'm not going to feel guilty because I'm the one who comes in and buys their stuff at a discount, from the repo man or the bank or whatever. That's not my problem. That's not my fault. I do community service. I'm here on YouTube 3 days a week giving it out for free. So that being said, real estate sector looks bad. I mean, we've confirmed into a bear market now. We haven't gotten the retest of 200 exponential and simple. We'll pay attention to that. We hit our trade target to downside, so we capitalized on over 20% moves to the downside with a risk reward of 3 to 1 based off of our lower high, double top or head and shoulders pattern right here. Played out perfectly. Not looking for a trade currently in the real estate market as we're at support, and we basically have just taken profits on this one already. So that being said, next target to downside would be 0.5. We're already below the pre-pandemic highs. We're already at the 382. So in all reality, I would expect more people to probably start taking profits around this level and possibly see what appears to be like a short squeeze or a counter trend rally as people are taking profits on positions such as this. But the truth is, real estate probably going to be wrecked into the future. It's probably going to be terrible. So, while the chart held up longer than most, if you didn't see this distribution taking place right here, I don't know what to tell you. This is literally, textbook distribution pattern taking place and then confirming. So when we look at our moving averages and we look at our price action, this right here, this type of price action and what we're seeing right here is literally textbook for the end of a trend. So 200 simple crosses above the 200 exponential. We're running out of momentum. We put in a high, then we put in a lower high. So now we're, potentially entering into a bear market. We break down below the 200 exponential and simple, and now they flip red. So, we see this distribution taking place. It's very clear we're literally losing key support levels and breaking down. There's no reason that anybody should have been on the wrong side of any of these trades. There's absolutely no reason. And if you were on the wrong side of these trades, if you're trapped upside down in positions, I'm sorry, that sucks for sure. But you need to evaluate, why are you trapped in those positions? What was your plan? Where did your plan go wrong? Who were you listening to? Why were you lulled into a false sense of security when it was so obvious that here we're going into a bull market and here we're going into a bear market? And if you can't be real with yourself, you're probably not in the right space, because there's only one truth in the markets. There's one truth. You don't get to pick your truth or whatever. You don't have to talk about it. You don't have to tell your wife or your family or your dog that you lost, 40% of your money, or 70% of your money, or 20% of your money. You don't have to tell anybody about it. But that doesn't change the truth. It doesn't change the reality. So if you can't accept the reality yourself, if you can't get down to it and figure out what went wrong and why, you're probably not doing the right thing here. You probably shouldn't be in these markets, at least not actively trading, probably not following this channel. XLV is next. So healthcare, again, distribution pattern, the breakdown, the weak right shoulder into the 200 exponential and simple, the loss of the neckline, the breakdown of the 236, again, 382. This one's holding up better than most, but we have a target down here of about 111 on healthcare. So, and again, these are the safety sectors. We talk about it all the time, real estate, financial sector, healthcare, utilities, consumer staples. These are supposed to be the safety places to go hide and run and be safe. Well, when people talk about safety plays, it doesn't mean that you're not going to lose any money being involved in these things. It just means you're going to lose less money. So in many ways, it's important to distinguish, you're probably a regular investor. So you don't have limitations on how much cash you can hold. You don't have a situation that says you can only hold 5% cash and you have to deploy everything else into the markets one way or the other. You're not a hedge fund. So, you need to make your own decisions and not listen to what some of these financial, people are saying online. Saying, oh yeah, we're going to go to this, we're going to go to that, we're going to protect ourselves, downside protection, we're going to go to safety plays and utilities, etc. You're thinking about cash. Thinking about alternatives, what's been working for 40 years isn't working. The whole, bond stock portfolio isn't working. Everybody's so far out the risk curve right now, and we're now seeing, money get more expensive than ever been before. At least recently, at least recency. The recency bias tells people that the Fed will jump in, will bail it out, et cetera, et cetera, et cetera. But the problem is we never had inflation all those other times. So that's what we have to pay attention to. Healthcare still looks weak. Still looks very weak. If we flip out to the weekly though, it looks like sometimes we're in the middle of nowhere. It's always important to go to a longer time frame and see, all the way down here is the 200 exponential and simple, about 111. So, that's our target, the 382 to the downside, and it comes in line with the 200 exponential and simple, and then obviously slightly lower we have the yellow resistance, what should be support pre-pandemic highs. So, so that is our healthcare sector. XLB. So materials, obviously, again, we see that similar type of distribution pattern taking place. We see a key breakdown of support that we just talked about in the last couple of days. We talked about once we break that support, our target to downside is to 236. Obviously, all those things have come through over the last couple trading days. So hit key support. Next support would be the 382 around 65. The pre-pandemic highs were around 62. But again, this thing is lagging behind most. And it's realistically, we did confirm in a bear market right here. We retested, and then we basically double or triple topped. And then again, confirm into a bear market here. And then this was our breakdown. And the most important thing now is here we saw confirm into a bear market, but then we came back up here and retested the highs. Then we confirm into a bear market and retest the lows. Then we come back up and put in another lower high. And then this breakdown right here, the two important things are here we put in a lower high. That's very important. And then here we broke down and put in a new low. And that tells us, obviously that something is different now. We're taking out this key support that's been acting as support for, for the last over a year. So once we lose that level, it's basically free fall. And that's what we're seeing take place. So, still has a ways to go on this. Arguably much better looking than most of the other sectors. XLY, consumer discretionary, already down at the 0.5. Already down at pre-pandemic highs, retesting. So obviously this has held up horrendously. And we've talked about the psychology behind that, obviously, as well. More consumer discretionary money is spent by more savvy investors or more, educated or wealthy investors. So they tend to pull back on that spending as they see macro, factors in the economy. Like if you're a business owner, your business is slowing. You talk to your other friend business owners, all their business is slowing. And then you start saying, maybe I don't need to buy that Tesla right now. Maybe I don't need one more Tesla. Maybe I don't need, quite as much Gucci or, new Rolexes or, whatever the situation is. So obviously breaking down from key levels, looking very weak. I mean, this is one of, arguably in many ways, one of the worst sectors right now. XLU utility. So we've been talking about this long-term channel right here and the potential not only obviously to come down and threaten the bottom of it, but also the potential breakdown and where that could lead us to. Now, granted, what is the likelihood that we break down from this channel and then see further downside? It's not that likely right now, but it's possible. We've been in this channel since 2008. And this is a beautiful textbook channel right here. I mean, this is, anybody can draw this on their chart. So if anybody can draw it on their chart easily, that means everybody's probably looking at the same thing right now. Well, they're probably looking at a 1 hour as where we're looking at weeklies, monthlies, minimum dailies. But that being said, this clear channel right here, support, we're threatening the lows of the channel again. So at this point in time, and this is a nasty red candle right here, not to be unexpected, obviously. But that being said, 200 exponential and simple lines up with the 382. The initial measure move for just the bottom portion of the channel takes us to the 0.5. The macro move for the entire channel breakdown, the measure move would take us down past the 618, possibly as low as the 786. Does it have to happen? No. But we're seeing some clear signs of weakness in this, and we've lost key levels. And if we close this weekly here in 4 hours below support, we probably get a situation like this, where there's a battle to see if we can, the battle will be, we broke support, we're going lower, some people will say. And other people will say, we broke support, let's buy this up, anticipating that this is, essentially like a spring, and then we're going to move back to the upside and reclaim that support. Typically what I like to look for is not only just a close below support, but I like to look for an open and then a close below support. And then that gives me the confidence I need to tell me, hey, we lost support. We had a little price action since then, and we're unable to reclaim it. So likelihood is we continue with the trend. And in this case, once you lose support, trend would be to the downside. I do expect at least short term 62 to hold for now. And then the little battle between the 200 exponential and simple, little battle between the support level, and then we'll see what happens. But as long as we're between 62 and, basically between the 382 and the 236 is like no man's land. I think, and we're right smack in the middle of that. So if we come back down to the bottom, I think that'll be a temporary, at least buying opportunity, even though we've lost support. If we come back up to 236, that'll be a temporary selling opportunity as we're selling into resistance. And then we'll let the market decide and see what's going on. But, looking at the longer time frames, looking at the daily now, Again, we threatened the 200 exponential and simple a couple times along the way, but this is by far the nastiest break of them. And again, we have confirmed officially into a bear market. Now, again, we had a little confirmation here. We put in a new all-time high afterwards. So it doesn't have to be the end of the world, but there's definitely some things telling us, hey, these markets are disgusting and getting worse by the day. XLC communication, obviously trash. This is the actual worst sector. The actual worst sector. So we're at the 618 already. We're below the pre-pandemic highs right here. I mean, this thing is just absolutely beat down and murdered. And we would expect that, because most of these communication companies are trash. Who's in communication? Who are the big names in this? They're trash companies. Come on. I mean, we know that. Meta. Come on. Get out of here. Twitter. Come on. Get out of here. Yeah, AT&T. Anyway, just trash. I mean, we're at key support level. I mean, I don't even think this thing can break down at this point in time. Who's left to sell this garbage? Maybe the 786 is our next target? I don't even know. Right now, thinking that communication is going to come down to 786. I mean, if this is the prequel for what the market's going to look like coming into the future, I mean, 618 is already nasty. But if we come down to 786, I mean, we're literally like threatening pre-Rona or Rona lows at this point in time. So absolutely nasty. Absolutely nasty. And I'm going to tell you something here too. We're typically focused on the United States stock market right here. If you look at short term, sure, you could find a couple other countries with a better looking stock market short term, the United States. But if you look long term, the United States has been the place to be. So most other stock markets look substantially worse than this. So if the United States, U.S. stock market looks like this, chances are your country's stock market probably looks substantially worse, especially with the strength in the dollar we're seeing as of late. So I would be very, very careful, and I would be paying close attention to what's really going on, not just what you're being like spoon-fed bullshit. So XLK, tech sector, this holding up actually like decent in comparison. We are at the 382. We're at the bottom of the channel. We're seeing multiple levels of confluence. Obviously not bullish on, tech by any means. But again, we're seeing what would look like potential area that we would expect our next bounce. So, and why do I keep saying that? Why? But you're bearish all the time, and then you keep saying you're expecting a bounce. It's called trading. So here we come down to 236. We get a fairly aggressive bounce back to the top of the range, back to retest support. So then we break down from the 236. We come down to 382. Slinky theory. So Slinky goes down the stairs, tail whips up. Slinky goes down the stairs, tail whips up. Slinky goes down the stairs. So at some point in time, probably going to see the tail whip back up. So, once we start seeing confluence on all these things, whether it's from the 382, whether it's from the 0.5, the 200s, the Rona dump on some of these other asset classes, etc., eventually we expect that bounce to take us back to the upside. And as we've already confirmed, let's say we get to 200 exponential, we're looking at a potential 20% move right there. So if we run a nice stop loss and we can find something like a 3-to-1 or more risk reward ratio, there's nothing wrong with taking a counter trend trade as long as that's what you're doing. You're taking a counter trend trade. The probability of success is below 50% because you're trading against the trend. So you just want to look for a higher risk reward ratio and, still trade the same way, but trade knowing that there is, a good chance you're going to be wrong. And that's okay. So XLE energy. So look, I say it all the time. I'm not going to sit here and try to call the tops on stuff. And then, you know what? I'm guilty of it. I call the tops all the time. I call the bottoms all the time. I shouldn't do it. It's a bad habit. I don't want to teach you guys that. That's why I constantly reiterate, we're not trying to call tops. We're not trying to call bottoms. But also, though, it's important to be able to identify them and have key signals take place. So obviously, we call the top on energy. At least for now. We don't know this is a macro top. But, I mean, it's enough that you don't want to just sit here and take it, in the backside, down 20% in the last 1, 2, 3, 4, 5, 6, 7, 8 trading days, 20%. Been talking about the energy trade was overcrowded. Been talking about we're, overvalued. We need to see a reversion to the mean. Talking about the hard sell signal. Talking about the 821 cross on the daily. Talking about the red histograms, the slope line, the zero line. I mean, it's obvious, right? Of course it is. In hindsight, it's obvious to us in advance. It's obvious to everyone else in hindsight. So energy looking pretty damn toppy right now. And you know what the truth is? When we come out to these longer time frames, the weekly, this is the move we've been talking about. A breakdown below the 821 cross to the downside, hard sell signal, leave the bullish control zone, multiple red histograms in a row, and then a retest of either the prior top right here, one of these key resistances to act as support, or again, the 200 exponential and simple. So for me, I look at this chart and I say, this is very, very bullish on the weekly. We have a 200 exponential cross over the 200 simple for the first time since 2015. And the last time we were coming out of was 2014. Well, that was like the previous high in this. So that tells me that if we're confirming now into a bull market after essentially like 7-8 year bear market, that we're probably at the beginning of a bull trend. That being said, I'm very, very bullish on energy going into the future, especially as long as we have all these retards at the helm just doing dumbass shit nonstop. They're like, oh, let's sanction Russia. Oh, let's shut down our own pipelines. Oh, let's transition to the clean energy of the future. Also, while commodities are ridiculously expensive and, there's not enough actual commodities to build all the batteries and the charging stations and the solar panels, and all that stuff's built on diesel. And when you do the actual breakdown, most of that stuff in its existing lifetime with our current technology doesn't even pay for itself and is net carbon negative. But who cares, right? Because it's not about actually doing good stuff. It's not about actual intelligent policies. It's not about that. No, it's about woke virtue signaling. No one gives a shit about the actual problems. They just want to virtue signal. They just want to act like they give a shit. Okay? If you're poor, I'm going to tell you something right now. No one gives a shit about you. These politicians don't give a shit about you. They just act like they give a shit about you because they want your stupid ass to vote for them. And I'm not calling you guys stupid. I'm saying people in general. And it's the same way with all this stuff. These companies don't give a shit about, economic and social governance. Why are some of the top-rated ESG, stocks or companies, oil companies? I mean, what the fuck are you? They purchase carbon credits. So it's good now. They're okay because they offset the bad carbon stuff. Why isn't Tesla one of them? I mean, get the fuck out of here with this shit. This woke virtue signaling is an absolute joke. And you know what? You deserve it. These people deserve it. They deserve everything they get. I'm not saying either that Republicans are good and Democrats are bad. All politicians fucking suck. They all suck. None of them give a shit about anything but lining their own pockets with corrupt money. And this isn't just the USA, it's everywhere. So just because I hate on Biden and the Democrats, and the woke mob, doesn't mean that I don't feel the same way about the morons on the other side. They're all fucking morons. Okay? It's just a matter of we're just talking about the morons that are in charge right now. And, it just so happens that they're doing a phenomenal job, giving us shit to make fun of them for because they're stupid. So that being said, XLE, would not be surprised to see this thing pulling back down to like $60. Very, very bullish if and when we do. But again, is this big, thick red candle a surprise? No, not at all. Obviously not. 100% no. All right. And then obviously energy, very important because that is the first of the horsemen. Okay. So energy potentially getting, what could amount to, a blow off top or bearish engulfing candle or whatever you want to call it. Well, how often have we seen aggressive moves like this? And then what happens once we get a massive bearish engulfing candle afterwards? Well, we saw a pretty aggressive move right there. And then we saw a pretty nasty bearish engulfing candle, 821 cross on the monthly, and then serious downside. Saw a pretty nice run up right here. And then again, we start breaking down with 821 crosses to the downside, going to a nice long consolidation downside period. So we're still well away from that now, but we're seeing the signals. This big, nasty, bearish engulfing candle is not what we want to see. So is this going to be a blow off top on oil? Is this the peak? The same way, we saw those peaks in, 2014 or 2008 or 2000. I mean, realistically, let's look at what the peaks were. Where were they at? Well, this is 2000 and then, capitulation. This is 2008 and then capitulation. This is 2014. And then capitulation. This is 2018 arguably, or you could go from, the 2020, however you want to look at that, and then capitulation. And then again, this is us currently. So what do we think's more likely to happen? That energy just keeps going up indefinitely for the rest of our lives? Or there's probably, this trade's overcrowded and there's a pullback and we're just seeing the beginning of it. I would say that one. So key levels to watch, obviously, on the weekly, we've talked about, 200 exponential and simple, obviously on the daily as well, and then here on the monthly, a retest after breaking above, coming back down, retesting them as support holds, and then we could see that continuation that takes us to new all-time highs. All right, so that's energy, and we know that every time we see a peak in energy or a blow off top or that equivalence, which we're seeing all over the place on these charts, we know that typically corresponds with a recession or a depression or, return to fair value, at least temporarily. Because obviously higher prices kill demand, and energy is required for literally everything. So next to the four horsemen, transportation. Transportation having a complete meltdown right now. Just absolutely just nasty. All the way back down at the pre-Rona dump levels, breaking down, descending broadening wedge, bear market. We've hit the 382, and then also we have the macro 236. I expect still continuation, but again, we're at very strong levels. This was our Rona dump right here. This was our previous cycle high, which was 2018 and 2017 in yellow, and we're actually below that right now. So we've completely round trip basically, to 2017, 2018 prices. So again, 4 years completely wiped out. Now, granted, the majority of the time it acted underneath that level. So most people are probably not going to be underwater. But if you bought anywhere literally since November 2020, you are. And that's not good. And then we know also every single time, again, and I'm sorry to keep reiterating these things, but I think people are missing the macro and what we're seeing take place right now. This is, 2011 bottom right here. And then we ran up to basically topping out around like that 2015 level. Saw that pullback, and then we run up again, and that's our 2018 level. And then we see, capitulation, and then we run up, and that's our 2022 level. And then again, we would expect that, nasty retracement, as every time we break out of one of these ascending channels, we then see a nasty retracement, typically between 30 and 66%. So, what's going to happen? Well, we're already down like 30 something percent of that move to the upside. So maybe it's done. Maybe that's it. And we just consolidate here, and then we just rage to the upside. It's possible. It's possible. I'd say unlikely, though. Obviously we have time cycle analysis here with the red lines on this chart. So we can tell that realistically, we should probably see some sort of like strong support level in like November 2022. So towards the end of the year, maybe we see this, starting to carve out a bottom, probably somewhere around like 52 or something like that. Substantially lower than where we're at right now. Very nasty right now, though. We're breaking down below the 200 exponential, already flipped red. We're below the 200 simple. Very, very nasty. So, but again, the same way we played these moves on the daily, the reversion to the mean play, and that was our last good bullish trade. We play that same trade on the weekly, and then, when we do get that trade off key support, and we do get that move, maybe that's the bottom, and then we accidentally went from, just a quick little scalp, some easy money, nice trade setup, to all of a sudden, whoops, we accidentally bought the bottom, and now we're in a positional trade that's probably good for another few years as we go into our next cycle. All right, and again, another one of our horsemen. So energy spiking right now. Uh-oh. Transportation capitulating right now. Uh-oh. So then we have semiconductors. So obviously everybody's been talking about semiconductors, very, very strong leading indicator. We're able to predict the crash in, the pre-Rona dump based on what we saw in these sectors, including semiconductors, obviously, as well. And now, again, we're seeing the same thing. We're losing key support. We're putting in new lows. We're confirming into a bear market. We see a pretty clear distribution pattern. Is it at head and shoulders? Is it just, distribution? Is it just lower highs? Who cares? Doesn't matter. This is hypothetical. I threw up what would be your most stereotypical distribution pattern, or most common head and shoulders. So, that's why it's there. It doesn't have to push back up here, but, maybe that's the reversion of the mean play. We hit the 200 exponential and simple. Maybe we only come up to 236. We get rejected there, come back down, retest support, and then we get the breakdown measure move. I expect this to go much lower in time. Right now it's holding up better than a lot of things, but it could get nasty. It's at the 382. The 0.5 would be our next downside target at 132. The 236 would be our next upside target at 185. So we're in between the 236 and the 0.5. So it's basically a coin toss at this point in time. So one of two things is going to happen. We either want to buy support right here, assuming it's going to go to the upside, well, counter trend trade, I'm not looking to buy support because the risk reward ratio is nasty, because we're basically in between our target to the upside and our target to the downside. We're right smack in the middle. So it's coin toss, and we're counter trend. So it has less than 50% chance of probability. So if there's a 60% chance that we're wrong and the risk reward is 1-to-1, that's a losing trade, because more often than not, we're going to be wrong and then we're going to lose. So we don't want that. Fuck no. So realistically, what do we want? We either want to buy after a breakdown or we want to sell after the pump. So we're looking to sell into resistance for our next play right here, because there's just not enough meat on the bone for a scalp to the upside, in my opinion. I mean, you could probably find a decent trade setup, but not the simple, easy, clear way that I'm looking for it. So again, looking very, very nasty as we now see our third horseman giving us signs of the apocalypse. And obviously, retesting the 200 exponential and simple lines up with the 382. The 0.5 lines up with about the 200 simple. So seems likely we go there. There's also one more important thing that I want to talk about. Actually, two things that I want to talk about in this chart. So this is the divergence signal I always talk about. It's kind of tough to tell with everything going on. But when we see the sell at the top of the range, and then we see a buy at the top of the range, and then we see the sell at the top of the range, sell, buy, sell, that's our divergent indicator. We see also divergence taking place between the jewel on these stochastics right here. And then we also see a spike high in the knife. So all of these things right here are telling us, you know, this is probably a macro top. Okay, we have bearish divergence here. We have bearish divergence here. We have, you know, all those other things we literally just said. You know, the sell by sell divergence signal, you know, pretty evenly spaced out from each other, gives them much more reliability. All that stuff telling us this is probably a macro top. You know, obviously since then, you know, this was at $250 and now it's at $150. So, you know, the smart move obviously was to, you know, either short that or get the hell out of the way. 40% down at this point in time already. I mean, that is nasty. I didn't even need the measuring tool because we have the 382. But regardless, nasty, nasty move right there. And, it, you know, potentially only just begun. So we'll see what happens right here if we bounce this up to the upside or if we break down. And then we can look for a potential trade. The second thing I want to talk about on this chart is everybody's looking at this and saying, oh, bearish control zone, hard buy, leaving the bearish control zone. That's bullish. So we should be long in this right now. Well, arguably, you're correct, because we're at support, you know, potentially 200 exponential weekly, the 382, you know, there's potential setup for, you know, some sort of right shoulder here before further breakdown, etc. But the important thing to notice is let's look at this chart right here. You know, we see one little green spot right here with a hard buy. And then the last time we really saw like much green at all is back here in 2012. So this thing has been, you know, this was obviously fairly bearish, as we have a couple areas of green right here. You know, bearish control zone, bears are taking over. We're losing 200 exponential and simple. That's fairly bearish area. And then after that, I mean, this is bullish the whole time. You know, the more red we see, the more bullish it is, because that just means the bulls are in control. We're in the bullish control zone for over 50% of this 10-year rally. So for over 50% of a 10-year rally, you know, with the exception of one little anomaly right here, we're bullish, and we're looking at the 200 exponential and simple as a buying opportunity, or in this case, the bearish control zone exit hard buy signal as a buying opportunity. The problem is that what we're seeing right now is different, because now we're seeing this green shows up and everything else looks like distribution, including this chart looks like a topping pattern right now. So is this just the beginning of seeing a bunch more green and the trend shifting to a bear trend instead of a bull trend? Or is this just that one-time anomaly where we retest the 200 exponential and simple and it's an amazing buying opportunity? We don't know. We do not know for sure, one way or the other. But what we do know is that on the daily chart, we're starting to see the chart look ugly and confirming into a bear market. So it tells me that we're more likely seeing a change of trend than we are just seeing a random little pullback buying opportunity before we go much higher. And again, you know, semiconductor ETF or semiconductor space or NVIDIA or whatever you want to pick, Marvell, you know, you can use as a proxy for the market itself. Just make sure what you're using is either one of the stronger ones or a broad, you know, ETF or something like that. But again, that's, you know, that's number 3. That's the third horseman. And then when it's all said and done, you know, we've talked about this countless times. You know, this is the 210 spread. And we know what that means. You know, technically, right now, the yield curve is not inverted. We inverted for a second back here. You know, we almost inverted or inverted for a second back here. It's technically not inverted. But, it's not as much about the technical inversion of it. It's about the psychology of the markets. The market is basically telling us like, hey, like 10 years from now, things are probably not that bad. So I'm willing to take, 3% interest for 10 years. But they're also saying, hey, and normally you get a higher interest rate on longer duration. On the 2 year, because there's extra risk for locking up your money. The longer time you have to lock your money up for, the more risk there is that something macro changes and less safe that money is. Like if I literally, you're my buddy, you work a good job, we're good friends, we're out at the bar, you forget your wallet, and I mean, I'd probably just buy you dinner or beers or whatever anyway. But the fact of the matter is, say you're like, hey man, I need to borrow, $50 to pay my tab or whatever. And I'm like, oh yeah, you're my buddy, you're responsible, we're at the bar together at $50. Sure, I'll loan you $50. And then you pay me back the next day. How much risk is there in that? Not that much. But let's say different situation, same buddy, good guy, et cetera, comes to me and says, hey, I need to borrow, $50 or $1 million, whatever the money doesn't matter, but, I want to borrow it for 30 years or 10 years. And I'm like, man, I mean, that's a lot riskier. I don't know what your life's going to look like in 10 years or 30 years, but, there's a pretty good possibility or probability that tomorrow you're probably not just going to all of a sudden be some scumbag. You're not going to lose your job. You're not going to lose your house. You're not going to lose your, wife and kid. Like, it's easier to judge what tomorrow looks like than it is 30 years into the future. So that's the mentality behind the 210 spread and why it's so important. Right now, the market is saying, hey, I'll loan you money for 2 years, but, I want to get paid. As opposed to normally, if you say, I want to borrow some money for 2 years, it's like, oh, no problem, that's fine. But if you want to borrow it for 10 or 30 years, it's like, I don't know what the next 10 or 30 years is going to look like. So, you have to pay a decent interest rate on that. So that's the mentality behind these and why they're so important. But that being said, that's not even the most important thing right now. The most important thing right now is we're seeing a technical breakout of this descending trend channel right here, etc. So, we're at the levels where we are basically threatening the all-time high or the previous high, which was our lower high consistently from 2018. So what are we seeing right now? Well, every time we hit this white line, shortly afterwards, we went into a recession. That's what the vertical white lines represent. And then the descending white line is just a descending resistance, a consistent lower high and lower low. No, that's not the one. Lower high and lower low, not ho. That's it. And, that's been going on for 40 years of lower highs and lower lows. And now here, and we, looking at the recession highs and lows as each a single event. Here we have 1, here we have 2, 3, 4. Each of those is at a key point in time. 1990, 2001, 2008, 2019, arguably, well, technically 2018. That was a foul that was the foul pivot or the Powell pivot. But either one, obviously applicable. The foul pivot or the Powell pivot. That's the one. But regardless, we see there's only 1, 2, 3, 4 data points that we're looking at right here. Each of those data points resulted in, a pretty big slowdown, recession, whatever. 90, 2000, 2008, 2018 leading into like the Rona dump, So key levels right here. Every time we hit it, we go into recession. Every time we come up here, we put in a lower high. And now here, this should be our next one. This should be another lower high. We should enter into recession and we should break down from here based on what the trend says. But that's not what's happening. We broke out. We're above the descending trend line. We're above the previous, high. So now all of a sudden we're doing something different. We've broken out of a downtrend that's been taking place for 40 years. And the last time when we peaked was actually when we had massive inflation. And what people forget about inflation, they're like, inflation's entrenched. Everything's just going to cost more in the future. Year over year numbers. Oh my God, just buy it now because you don't know what it's going to cost. And it might not even be available. So, hodl everything. Inflation raged for like a decade, all through the 70s, before Paul Volcker finally came in and, jacked up rates. It took like 10 years of sustained inflation and, you know, the horrible mentality or issues that it causes to people, you know, savers, investors, whatever, just in the economy. So that was a 10-year nasty just process of it just getting worse and worse and worse before Volcker had to like go nuts to destroy inflation. We don't have 10 years of inflation. We have 40 years of deflation, and then we have like a year, maybe 2, I guess we could say right now, of inflation. It's not nearly as bad. It's not entrenched. It's not what everybody's trying to act like it is right now. Like all of a sudden they're just going to come in and they're going to, you know, get nasty and they're going to kill the inflation and it's just going to roll back over and then we're just going to go back down to zero and everything's going to be gravy again. Yeah, I don't think so. That's not what the charts are saying. So, you know, it's important to look at these data points and actually use realistic things. Anybody that can pull up like statistics can alter what those statistics tell you. You know, that was like the first thing we learned in statistics, you know, back in college days 100 years ago. You know, they literally teach you about like, hey, the most important thing you're ever going to learn about statistics is everybody can have the same statistics and there's a way you can spin it to say whatever you want, good or bad. And it's a fact. It's an absolute fact. You can literally spin it to say whatever you want. And we see it right now from the current administration in the United States. Biden's like, we have record number of job creation. Well, no, you don't, because we have less jobs than we had going into the pandemic. So we actually have less jobs. So we have record numbers of people coming back to the jobs that they already have. Correct. So no, we don't have record numbers of jobs. As a matter of fact, we have negative GDP. So do more, or actually do less, because everything you do fucks up. So it's all about, you know, it's all lies. It's all bullshit. You know what I mean? It's like the Rona thing. You know, I'm not saying it wasn't real. I'm not saying it was an issue. I'm not saying people, you know, died, but we kept hearing these numbers like 1 to 3% of people are going to die from this. This is going to da la la. We hear all this stuff, you know, whatever. Now, was any of that true? Sure. Yeah. You know, 1 to 3% of people over the age of like 90 with like 5 pre-existing conditions did die from it. That is actually correct. But a perfect example of how those statistics are lies. We didn't hear in the beginning that the people that were having the most adverse effects were all like over the age of 85 and 90 years old. You know, we didn't hear about it. It was like, this is a threat to everyone. So just pay attention to these statistics and see how you're being manipulated with them. It's very, very important to understand, you know, what somebody could be doing or how they're potentially misleading you. So let me jump over in the chat real quick, say what's up to you guys, and then we'll keep on ripping and rolling. We're about an hour 22 in. I know I'm a little ranty today. I know you guys, some of you love the rants. Others of you like the rants. So what's good, fam? Said Sahil, good to see you, brother. Soto says, hey. Todd Schultz, good to see you, my man. Too many crypto clowns, YouTube channels out there that don't have a clue. 100%. You know, fortunately, they're all broke now. So Sotos says, well, good thing recession will help rid us of trash YouTube channels. Oh, yeah, I'm sure. It'll rid us of a lot of stuff. Soto says, on top of trash companies. Yeah, 100%, dude. I could not agree with you more. I mean, cryptos, influencers, stocks, we really just need to just, you know, wipe our hands of some of these zombies. Todd Schultz says, does anyone know if you can withdraw USD or USDC to your own wallets? Like a ledger? Yes, you can. You can put stable coins on your ledger or whatever. You just have to, I mean, you can look and find out. There's a list of literally everything that's supported by like your Trezor or Ledger or, you know, whatever. So I think I'm understanding your question correctly. Unless you're on one of these exchanges that has stopped deposits or withdrawals, rather. In which case, no, you can't. Todd Schultz, thank you. Scotty Scotsman, good to see you, brother. Hey to you as well. Jay Hoff, what's up, man? Good to see you. Almost missed the live stream. Stupid work. Yeah, man. Work does suck. I must agree with you that work is stupid. Jay Hoff says, seems the bots are quiet today at least. Dude, don't jinx it. I don't even know how the bots find me. They're just like, oh, finance? Yeah, that's a cockfest for sure. Let's get in there with some porn bots quick. These guys will love it. Yeah, last stream was just ridiculous. It was absolutely crazy. Can't believe all the bots. Sohail says, sorry if I missed it. Heard energy. Will you do oil also? Yeah. Eli says, what's up, Eli? Good to see you, man. Rants aren't always a welcome bonus. I'm glad I made the live stream. I'm glad you made it too, brother. Soda says, where's the sexy bot? Speak of the devil and he shall appear. I don't know. YouTube's probably taking a break. They're like, man, we already really harassed those like 6 people, so you should give them a break. So DXY, obviously we saw a little weakness in the DXY. We started talking about how this could potentially develop into some bearish divergence. We did get back above the slope line, and it is positive. We have some green histograms. Cautiously optimistic here. We're in the bullish control zone. We just put in a new high. We're finding support at key levels. We have a pretty bullish candle coming in here. Cautiously optimistic. Still extremely, extremely bullish on the dollar, on the macro, obviously. As we have put in a new high, and at this point in time, we are back at 2002 levels. So for everybody that's like, the dollar's weak, it's going away. The dollar's trash because they're printed so many of them. There's not gonna, the U.S., it's not fair. Okay, sure. You're right. It's not fair. But also, the dollar's the strongest that it's been in 20 years. So for all the people that were calling for, dollar at DXY at 60 and the dollar's garbage and, cash is trash and the U.S. is dying and they're going to lose their world reserve currency status, I don't disagree with you. But let's put a time frame on it, okay? Because people have been saying the same thing for 10 years, 20 years, 30 years, and they're literally the wrongest they've been since 2002. So now, does it amount to just another in a series of 3 macro lower highs? Sure, maybe it does, 100%. When we'll find out? Well, we'll find out when we retest 121 on the DXY. If we don't break above 121, then it's just another lower high. If we do, then it's a confirmed breakout of, a 40-year trend or so. Now, arguably, though, we did already have a lower high right here. So a lot of people were already looking at this as a high, a lower high, and then a lower high. So once we took out this lower high right here, we need to now look at, what's our next lower high. And again, it's this one. So at this point in time, target on the dollar is 121. I have some other targets based on the fibs and everything, but still very, very bullish on the dollar. I mean, this is juicy. This is a breakout and confirmation into a trend for the first time in 40 years. Since 1986, we have not seen the DXY above the 200 exponential and simple. And now here we have confirmed above the 200 exponential and simple in 2019. And obviously we're able to identify absolutely beautiful double bottom with bullish divergence, and then internal bullish divergence as well prior to this macro move. And you guys know that, like we've been saying, for literally a year plus at this point in time, we have the largest cash positions percentage-wise and dollar-wise of our lifetime right now. And look how that has played out. The absolute best trade you could have had in the last year or so was either cash, US dollars, or energy. Commodities, depending on the commodity as well. So, nailed it. Got the best couple trades and we nailed them. So let's look for our next beautiful macro trade that's going to make us very, very wealthy. So that being said, next we got Tesla threatening the lows right here, confirmed into a bear market, starting to see some serious pressure on Tesla at 650. Our next target to downside is just retest of, it's just a retest of the bottom of our descending triangle, which is obviously our target here at the macro 236. We're already at the shorter term 236, macro 236 slightly lower, around 538. We talked about potential trade setups from where we're at right now, with 34% upside for reversion to the mean retest of a 200 exponential and simple with an 8% stop loss, 4.2 to 1 risk reward ratio. The real trade, the one we want, the juicy one, is not that one. That's not the one we want. We're not taking that trade. I mean, there's potential for it for sure, but that's not what we want. Now, we are seeing some potential bullish divergence could develop right here, in which case maybe we do end up taking that. But the real trade we want is over here. This is the one we want. Off of the macro 236, off of support at about 537, and that retest of these key levels right here. And that gives us, with an 8.8% stop loss, 64% upside target, 7.27 to 1 risk reward ratio. So we risk $10. If we're right, we get $70. If we're wrong, we lose, was it 88 cents? So, not bad, right? Wait, I might have said that wrong. Did I say that right? I think I said that right. We risk $10. If we're right, we make 7. If we're wrong, we lose roughly 1. So that's what we're looking for. That is what we're looking for. We're looking for the 236. What's going on with Elon right now and all this craziness and Twitter and everything like that. I mean, I honestly, I pay attention to that stuff, but I can't really like trade that. I don't have an edge on what Elon's next tweet is going to be or whether or not he's going to buy Twitter. I do know that the 530 level lines up perfectly with the 200 exponential. So that seems like a high probability target. So that's what we're looking for on Tesla. And we got to be careful too, because we know Tesla's overvalued short term, probably undervalued like really long term. But time horizon is very important, because if we see it at 500 or 300 and then eventually it goes to 2000 and you're like, I'm bullish, but then it goes to 300, you were wrong because it got cut in half. But on a long enough time frame, you could be right, but I don't want to be right if I have to get cut in half first. No, thank you. This isn't a fucking magic show. ARKK, trying to put in a double bottom right here. I mean, this thing is capitulated. I've talked about this repeatedly. This is a very, very strong support area where we basically just went sideways for year after year after year. Please keep in mind that of all the accolades that Cathie Wood has been given, that she has literally wiped out all gains back to 2017 levels. So arguably, aside from things that go out of business or have gone out of business, the ARK investment stock portfolio theory hypothesis is literally the worst thing you could have ever done. You basically, it's like a coin flip between if you want to listen to Cathie Wood and lose all your money, or if you just want to like buy a company right before it goes bankrupt. So it's coin flip. Which one's going to be better? Which one's going to be worse? Could go either way. We know Cathie Wood is a failure. We know that. It's a fact. It's not a surprise either. Very unfortunate, as the cult of Cathie is strong. We're at 618 key support levels. This should be where we get some kind of bounce. Instead, we're just seeing like pathetic consolidation. So is this going to be the bottom? Probably not. This thing probably, I would not be surprised literally to see ARKK put in a new all-time low and completely wipe out anyone that's ever purchased into this fund. Going back to 2014, I would not be surprised to see a new low below $15 in the near future. I would not be surprised. Does that have to happen? No. It's already nasty as hell. Matter of fact, we should be buying this right now because it's down so much. Unless Cathie Wood is a moron because she's trying to day trade and then telling people that she has a 5-year time horizon. If I told you I have a 5-year time horizon, I'm going to buy this house and as an investment, and in the future it will be worth money. You'd be like, well, that makes sense. 5 years from now, sure. And then if the next day I was like, yo, I sold that house. And you're like, what? I thought you had a 5-year time horizon. And I'm like, yeah, but, looked like a good opportunity to get in and get out. And then like a week later, I'm like, yo, I bought that house back again. And you're like, wait, what? I thought you just sold that. Didn't you have a 5-year time horizon? And you're like, yeah, I did. Hang on 1 second. And then I sell the house again. You're going to be like, dude, that's not investing. You're day trading. You're swing trading housing. And what should be an investment, you're swing trading or you're day trading. That's what Cathie Wood is doing. She's literally day trading and then telling people she has a 5 to 10 year time horizon. That's not how it works. You're dumb. You're dumb. Not you, her. So yeah, trash. Garbage. Is it bottoming right now though? Maybe. I think if everything starts to see a pop, in the near future as we hit these key support levels, there's definitely a possibility that ARK does as well. In all reality, what would we expect? 31% move is like not that bad, right? Sure. And then if you capitalize on that 30% move, then you're only down 69%. That's not bad. Plus 69 is great. So, but yeah, down 77.6% from the high right there. So, trash, garbage, loser, losing investment. And then EDU. So this was one of our China plays. None of the drawing tools work anymore because they did a reverse split. But I had a nice little run up. Got back above the 200, threatening the 200 exponential. I think that's the next move up to like 26. Quite a bit of resistance there. I don't think we get above that. Not anytime soon. Not without a prolonged consolidation here. If we do get above 26, though, there's a massive gap leading all the way back to 58. And obviously the gap fill is like our eventual target or internal retracement from the previous all-time high to our swing low. Looks pretty good right now. Obviously built up quite a bit of momentum. The initial target was a retest at 17. Now we're at like 21, which was where that consolidation was before we ended up, that trade setup before that we were looking at failed. So when it's all said and done, you know, I obviously have a position in this. I'm expecting 2650 or something like that. If we break down back below 17, I'm not really interested in this anymore, at least for now. But it does look good. It's building momentum. And then we can start paying attention to, does this eventually consolidate long enough and then get back above the 200 exponential and simple and then start to look like, you know, it's going back into an uptrend. Now, do I think China's done selling off and all of a sudden everything's good? Or is this just a bear market rally? I think it's a bear market rally. I think it's a bear market rally for sure. You know, China just reopened. They're easing some of their restrictions, you know, blah, blah, blah. You know, the same narrative we've heard for the 19th time. Same thing with NEO. Had a nice bounce off of that capitulation low. You know, people thought that I was crazy when I was saying that this thing would be down in, you know, probably single digits in the near future when we were at 67. And I kept reminding people, you know, keep in mind this thing almost went bankrupt. And it was like between $1 and $4 here for a while. Made it down to like $11. I think it's going to go much lower. Still looks like it's going to go lower. So we'll see what happens. But obviously we have hit some key targets already. Eventually we expect the retrace to the 0.5. And then potentially like that's a macro retrace. And then we go much higher. We'll see. But $8 still my target to downside. We have a low right here. Then a high right here. Then a lower low right here. So if this comes up here and gets above the 236. Gets above the 200 exponential and simple, you know, maybe I'll change my tune and maybe we already bottomed. I don't see it right now. I don't see it right now. Just not looking to get bullish on China. You know, there's definitely some scalps to be had right now in these recent moves, but I just don't see enough shifting. I see the narrative trying to shift, but I don't see the actual like technicals or fundamentals shifting. NVIDIA. Oh, we already looked at semis. This thing's just breaking down. New lows, no surprise. Targets down here. Obviously, we have the internal retrace of what I'm looking at is these 5 waves. And then we have like the macro as well. Macro 382 is like 138. So that's what I'm looking out for. The internal retrace of the 786 is like 144. So I would expect something around that. We'll look some potential, you know, for some bearish or bullish divergence here. New low. You know, plenty of juice on the histogram. This could easily just keep going down to the downside and doesn't put in a new low. But we have one drive of, you know, bullish divergence here. And then arguably looking to build a second drive on top of the slope line. It is still negative, but we could find support here. So we'll see. We likely see a little further downside. And then again, we see like that dead cat bounce kind of like action. And again, we have, you know, what amounts to basically a high, a low, a lower high, a lower low. We're in the process of literally putting in new lower lows every day. So I don't see any signs that anything's going to change anytime soon. We are very much below the 200 exponential and simple and confirmed into a bear market. And our weekly close this week is just above the 200 exponential and simple. So if we just go slightly lower to 143 or 121, basically lines up with the confluence of our other targets right there. And that's the area we're looking for. 382 for a scalp move off of support. Apple, so Apple breaking down, you know, obviously we heard the big talking heads and all those people talking about how Apple can't break below 136. 136 is strong support. Buy 136, 136, 136. That's all they've been saying is 136 and how strong it is. Trade the range, buy 136. Well, now we're at 132. So congratulations. You did it. You bought it and then it went lower. Great job. 200 exponential and simple flipping over. We're now seeing bearishness in these big names, these big stocks, these big market cap leaders. And on their way down now to retest the 200 exponential and simple. So obviously looking for a target around like 110, possibly as low as 102. Around $100 seems right. 382 comes in line right around then. We also have key support from our little like channel action right here. 0.5 coming in closer to 200 simple. Depending on how long it takes to get there. I think probably 114 or somewhere around there is our buying opportunity. Again, looks weak. Looks stronger than most, but weak. Google, again, same thing. Breaking down. Did not put in a new low right here, so it's holding up slightly better than many of these others. We front ran the 382. I think we come down here to the 382, and then we're looking for that scalp play to the upside, the reversion to the mean retest of a 200 exponential and simple, and previous support term resistance, potential for more drives of bullish divergence. We saw a couple drives of bullish divergence. We got a nice little pop to the 236. I do expect this to come down to the 382, and then we'll see what happens from there. We're either going to underperform as we put in another lower high and then break lower, or we're going to break through that one. People are going to get real bullish, and then it's going to run up to 200 exponential and simple, or retest that resistance. And realistically, that's about a 20%, 26% move to the upside. And again, we do know that there's a split coming up now. Apparently, I was the only one who didn't know, but 21 split, July 18th. Oftentimes, we do see run up in advance of that split. So what would be the absolute, textbook scenario? Well, we come down here, we hit the 382 perfectly. We enter into our scalp trade to the upside. We see a run up leading into the split, push all the way back up to 236, possibly as high as the top of the range, our target, 26% upside. And then we sell into that resistance as we're basically buying, the, oh my gosh, buy the rumor, sell the news. So, obviously the split is, for whatever reason, we've talked about it before, but, it's thought to be a bullish event. I think in this case, it actually is, though. There's a lot of people who would probably buy Google, but won't buy it because it's 2,100 and they don't want a fractional share. Just psychologically, people don't like fractional stuff. They don't want to have to share with someone else. So that being said, a 20-to-1 stock split on this is going to put it around like, $100. So I think it's much more viable that you get just average Joe putting, Google and Amazon and, possibly Tesla with an upcoming split as well in their portfolio. So we'll see what happens. Was that Tesla split actually announced, or was that just Elon talking shit? Yeah, I don't know. I don't actually see anything on here. I only have just heard talks about it. So I don't know if that's actually confirmed or if Elon's just trying to manipulate the bear market, but we'll have to pay attention to that. So Amazon, we hit our target, $100 on Amazon. Obviously, that was anticipating 20% split. We see leading up to the split, and this is the exact situation. Oh, I forgot. I think I accidentally cleared this chart. Maybe I did it in, a blind rage. I'm not sure. I don't know why. I swear we had drawn on this chart at some point in time. But that being said, not really bouncing like key support or anything in particular right here. But we saw that run up leading, basically we had earnings capitulated, and then we saw a run up leading up to the split. The split was the absolute top, blow off top at the 0.5. And then after that, we revisited the lows. So, we were calling for $100 Amazon back here. Obviously, at the time, it was like $3,000. But we knew there was going to be a 20-to-1 stock split. So, it's just math. I mean, magic. It's magic. That's it. At some key support levels, I don't know how. I mean, this is pathetic. We're at 2018 levels on this. Amazon is, just completely performing like garbage right now. Is it overvalued? Is it undervalued? Depends on the time frame. I think it probably was massively overvalued, and I think now, on the weekly chart, technically it's undervalued. And again, look at this move right here and how the technicals and the fundamentals lined up. So we saw a run up because of earnings, right? Or the sell-off was because of earnings, and then the split was the run up. Well, also, we broke down from the weekly 200 exponential and simple, and then the retest, the reversion to the mean, was also the run up. So we ran up perfectly because of fundamentals, because of that stock split. But also, that same move was a technical move that we were able to anticipate because that was the reversion to the mean. At which point in time we got rejected, and then we put in a new low on that gap down. We came back up, filled the low, and then we're about to close a new low, theoretically on the weekly. So we have a ton of support through this area. It's going to be, strong support. We chop around here for like a couple years. So, it would make sense that it takes a long time to get through that. And maybe that ends up being macro support and we don't get through it. Obviously we don't know. But overall, this thing just goes up and to the right. But we're also doing something we haven't done since 2008. 2008 was the last time we broke below 200 exponential and simple on Amazon. And then before that, the 2000 blow off top right here was a full-on capitulation event. So is that what we're seeing right now? I mean, there is a legitimate possibility. I'm not saying this happens right now, but there is a legitimate possibility that we actually see a real retracement in markets. Now, again, I'm not saying it has to happen. I'm not saying it will happen. But there is definitely a non-zero possibility that we actually, if you understand Fed policy and how they basically kick the can down the road, and we've basically just been creating cheaper and cheaper money in order to fuel this massive debt bubble to, essentially create like fake growth in the economy. What really happened? Well, from 2001, we just ran up to a potential macro high right here, and now we're doing something we haven't done, on this uptrend going up here. So what if that is a macro high? And what if we have the most shallow retrace possible on Amazon? Where does that take us to? Well, we'll look at the 236 right here. That would be the most shallow retrace before continuation to the upside for a macro 236. That's $40. That's over, 60% down from where we're at right now. Now, it sounds lower than it is because we just had a 20-to-1 stock split. But $40, times 20, 800. Wait. Yeah. Man. That's second guessing myself. Oh, it's been a long week. TGIF. So, does that sound as crazy? I mean, sure, we were just at 3,000, 3,600. So it's like, no, it'll never go to 800. I mean, never? It'll never go? Never? I don't know. It's got a higher than 0% chance, if you ask me. So that's what I'm looking for, is a macro bottom around there. So, that's obviously far out into the future. Doesn't have to happen. Probably doesn't happen. But, it's worth paying attention to. But honestly, right now, this looks like we were just about to confirm into a bear market and break down lower. So I would not be surprised at all to see the 786 retest under 100, then the 886, 90, and then really just complete round trip to that low, which would be 81. And this was our Rona dump right here. So, we're already the majority of the way to the Rona dump. Not good. Not good. If you already own it. Good if you want to own it or own more. Microsofty. So obviously head and shoulders breakdown, confirmed bear market, looks like trash, hit the fib level perfectly. We front ran it the first time, had a nice little pushback up to resistance, and then what did we do? We came down and tagged it perfectly. So we've been talking about how a lot of these charts have front ran our target slightly, or hit our target but not the fib. And then what happened? Nice little push up, and then we hit our target. So now do we get another pushback up, or did that already take place? We'll have to see. The reversion of the mean play is the one we're really looking for here. For that 19% upside, 3.4% downside on Microsoft, 5.6 to 1 risk reward ratio in one of what has been and is arguably still one of the stronger large market cap stocks. Now we do have the 200 exponential and simple slightly lower at about 219 and about 200. So some key levels to watch there. Obviously 200, nice round number. Wouldn't be surprised. 821 across the downside. It looks inevitable at this point. We saw on this one, it's not the case that when we get these 821 crosses, we often don't get down to the 200 exponential and simple. Matter of fact, like the last 5 times we did it, we didn't make it to the 200 exponential and simple. We're almost there now. So, if we're going to do the same thing as last time, it's probably going to get front run. If we're potentially putting in, what looks like a blow off top, like macro top type situation, probably not going to be a buying opportunity. And that's what I think. How many times did we go in the bearish control zone on the weekly? The last time we were in the bearish control zone on the weekly was in 2013 as we were transitioning into the bull market. So that was the retest confirmation or the reversion to the mean after confirming into a bull market right here in 2012. We ran up, we came back, reversion to the mean, held support, went parabolic after that. So now we have 10-year parabolic uptrend, and for the first time in that 10-year parabolic uptrend, we're seeing bearish control zone. I would say that looks to me like a change in trend. It's definitely at least worth paying attention to. All right, so that's it for the traditional markets. Let's jump into our cryptos. Remember, none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Bitcoin futures chart still looks like trash. New lows, garbage, capitulation. I cannot even begin to say how many times we have warned everyone for this. If you've been watching this channel for any amount of time and you just got caught with your pants down in this recent move taking place, I don't even know what you're doing. I don't know what you're looking at. Quit the cult. Quit the cult. because you're either gonna, cults end in two ways. You either end up, dead from the Kool-Aid or poor from them taking all your money, or you end up dead and poor. So none of those are good ways to end up. So get out of the cult. Get away from all these trash bag, fake influencer people. It's easy for everyone to look like a genius when everything is just going parabolic and you're just naming off trash bag stocks or garbage cryptos. It's different in a bear market. Now we're really going to see. Now we are seeing who really knows what they're doing. And I like to think that, I have proven myself exponentially to you guys. Can you say that for the other people that you listen to or watch or, influence you in your life? Probably not. So Bitcoin futures chart hit our 382 perfectly. So that's key support. The other key support before that was the 236 in green here. And that 236 in green, I really want to leave all this on here. I was thinking about cleaning this up, but what if we get rid of this one? I don't really need that one. So if we came down here to the 382 now, the 236 was holding up price action for that whole time. That was that support right there. And now we broke down from that. We hit the 382 perfectly. So typically around this level, we'd like to see, some kind of bounce. Now, do we have to? No. Could we just go sideways? Sure. Could we go lower? Definitely. No, we have obviously some other key targets along the way. 16,840, 14,795. It is important to note, though, that we did the first thing. We did something for the first time that we've never done before. And that is, basically retest the previous cycle all-time high from the 4-year halving cycle. Not good. Not good. And you're like, no, we didn't. We didn't make it there yet. Not on the spot markets. Whoa. Okay, well, we did on the CME futures. So this is our futures top right here. And this is where we're at right now. So we're touching tips right now. Okay. So, there's a sword fight going on right now between Bitcoin 2017 high and Bitcoin 2022 low. They're touching tips. I don't know who's going to win, but doesn't look good. Okay. Does not look good. Below 200 exponential, below 200 simple, 200 exponential is already flipped bearish control zone, all red histograms. 821 crossed the downside a while ago. This chart obviously looks like trash. No surprises here. And if we go to the daily, I've showed this plenty of times, but if we just look at the macro crosses of the 200 exponential and simple, and when we go into a bull trend, here we're bullish and it plays out very well. Here we're bearish and we don't get caught with the corona capitulation. Here we're bullish and it plays out exponentially well. Here we're bearish and we don't get caught with that, 30+% downside. Here we go bullish again, fake out throw over. Here we go bearish again. So now we have confirmed into a bearish trend once again on the daily. Bear market capitulation takes place afterwards. The moving averages and the slope / relative, price action to slope has played out very well. So you don't have to do what I do, but it sure does work. So you might want to consider it. Next, we have our Bitcoin Bitstamp chart on the daily. Again, this is a nasty chart. Tons and tons of stuff drawn on it. Please keep in mind that, a lot of this stuff has literally been drawn for months. And look how just absolutely beautifully it has played out. So we're essentially seeing what I think is the expanded Elliott wave flat correction. Here is our top of the 5. We then saw an A retracement, a B retracement to a new all-time high, which is a feature of the extended flat correction. And then after that, we see, A, we see the B, and then we see the C to a new low, at which point in time, obviously we hit our target to the downside. We hit our green box area. We hit the 382 perfectly. So now we're buyers, right? Because we hit our target. So it just goes up now. Sure. Probably for a scalp. But when it's all said and done, is this basically just going to end up being the 3 right here? And then next we get a 4 back to like this level right here. And then we actually get a 5 that takes us lower to like say the macro 0.5. Sure, I definitely think that's a possibility. And this actually is like, should be down here or something like that. Sure, it's definitely a possibility. We'll have to see how it plays out. But the truth is, my macro view, my macro chart on Bitcoin has played out perfectly. I don't know of anyone else that was looking for an extended flat. A couple people started talking about it way after I did. A couple people mentioned it in passing. People had talked about, potential for 5 waves. And then, who was it? Alessio Rastani came back and started talking about, basically the same thing I was like months later. And then he like immediately afterwards got a bunch of pushback from his community and then completely reneged on it and said, no, that's wrong. I was looking at it wrong. When I look at the Brave New Coin chart, everything changed. So just scratch all that. It's bullish. 100,000. He basically just gave in like a little bitch to the angry mob. But the fact of the matter is, and no offense, I used to like Alessio, but he's trash. Now he is sold out. I mean, this is what we're looking at. We're looking at a macro 5-wave structure. Here's our 4-year tops. This was literally the top of 2013 high. This was literally the top of 2017 high. This is literally the top of 2022 high. The red, vertical lines are the peaks. And then the bottoms are here in green. And then, oh, look, they're spaced out perfectly, from the point before them to call the other one. How did I do that? Oh, because it's a 4-year cycle. Just heard one of these other retard, huge YouTube influencers saying that the 4-year cycle is not valid. It's been invalidated. I mean, if you looked at this chart and said, there's something weird going on here. There's a peak and a bottom. There's a peak and a bottom. There's a peak and a bottom. And you're like, let's see if there's any time confluence or anything. And then you draw this right here and then you put the next one right here and you're like, oh, that's weird. As soon as we put the second one right here, it calls the top of the next one perfectly. Huh. That's strange. Must be a coincidence. And same with the bottom. Here's our bottom. Here's our bottom. And that can potentially forecast our bottom going out into the future around November 2022. Now, does that have to be the case? No. But I think there's a pretty good possibility of it. Probability of it. We'll see. Playing out perfectly. I mean, if there's one thing we could say, it's that we're consistently right. So that being said, people were saying, it'll never go to 20K. You're just mean. You hate crypto. You just don't understand it. It's the future. Duh. Michael Saylor and Venezuela are smarter than you are. Or Puerto Rico or what? I can't even remember what trash bag country. What was that? Argentina? Venezuela? Puerto Rico? No, it's not Puerto Rico. Was it Venezuela? No, that's not. I can't remember. It's Argentina, isn't it? Yeah, I think that's it. Anyway, all these people are wrong now. They're trash. They're down 30 to 50% on their 100 million to multiple $billion investments. So at some point in time, they too will capitulate, and I think that's when we're going to see the big, blow up. Because again, we've never touched tips before, ever on a cycle. And people are like, yeah, we have. You don't know what you're talking about. This is our top right here in 2013. We do not even come close on the bottom from 2019, or 2018, not even close. We're literally, the top is at 1,192. The bottom is at 3K. And then here we have our top from 2017. And now here we're touching tips. So it should act as support, at least for a little bit. Everybody knows 20K is support. How long does it last for? I mean, we'll wait and see, I guess. But does it look good right now? I mean, I would say no. But that's up to you to decide. Obviously, bear market. We look at the weekly chart, we're retesting the 200 exponential. We're below, below 200 exponential. Let's flip bearish. We're below 200 simple. And, this weekly closes in 3 days, arguably like the weekly spot market or the futures market chart closes today. So not good. Now, there is some things to pay attention to. It's not all bearish. Previously, we bottomed on 200 exponential and simple in 2014, 15. We bottomed on the 200 exponential and simple in 2018. So could we bottom here in 2022 at the 200 exponential and simple? Sure. And even the Rona dump right here. Sure, we could. There's also one more thing that I have talked about on multiple occasions that has some potential. And again, this is a monthly chart. So there's still 2 weeks left on this monthly. And then we're looking at next monthly. But here we saw the 821 cross the downside. And once the cross confirmed, that was the macro bottom of the bear market. Here we saw the 821 cross the downside. As soon as the cross confirmed, that was the macro bottom of the bear market. And then here, we're about to get the monthly cross of the 821 to the downside. So in 2 weeks, we're going to print a close on this. Unless we rally above 36,000, which doesn't look likely, we will cross to the downside. At which point in time, that next monthly candle could potentially be our bottoming candle. Now, does it have to happen? No. It did happen 2 times in the past. It's worth noting. It's worth paying attention to. The chart looks very bearish. There's not very many things that are bullish on the chart, but arguably that is one of them. That the 821 cross the downside on a monthly could actually be our macro bottom. Moment of silence for all the people that have already lost their money and won't get to participate. But yeah, I mean, you do whatever you want. You load up at 20K, you can load up at 10K, you can load up at 2K, if it gets there. Nobody knows where it's going, so. But if we make intelligent decisions in the meantime, such as buying support and selling resistance and trading with the trend and, position sizing, we get to keep playing the game. Ethereum looks like trash, already violated its previous all-time high. It's not even touching tips anymore. There's penetration going on here, and not the good kind. Below 200 exponential, below 200 simple. We don't see the same kind of support historically on the moving averages as we do with Bitcoin. And if we switch out to the monthly, we'll see we're about to confirm the 821 cross to downside. We don't see that same confluence as well with the crosses and the bottoms. So does not look good. Matter of fact, one could argue that Ethereum looks like shit. Oh, and it's also $1,000, which was our price target. So congratulations. We were right again. Bitcoin dominance. Obviously, we saw that breakout. We're coming back down, retesting. We obviously break out. We retest. We hold, what was resistance, acts as support. And then we would expect confirmation and continuation to the upside. So, breakout, confirmation, continuation. So we do still expect next target to the upside being 51%. After that, close to 56%. Obviously, Bitcoin rallied in relation to altcoins, or AKA Bitcoin sold off and altcoins sold off worse. And then obviously once we started to kind of bottom or carve out a bottom or, stopped capitulating, everybody was like, quick, buy all the trash bag altcoins that are total garbage right now. And then Bitcoin dominance, obviously, we see a big drop, a couple percent drop right here as people flood back into trash bag altcoins, hoping to make more money when we do get a bounce, if we do get a bounce. But obviously these trash bag cryptos will just end up costing them, massive amounts in the long term, because we don't want to own trash bag coins in a bear market. That's how you end up with $0. Some garbage exchange blows up, some garbage stable coin blows up, some garbage crypto blows up, or it goes 99% to the downside. And then afterwards people go, well, it was experimental, so they can't all be winners. Sure, but they also shouldn't go to zero. Total market cap, trash. We're down at 870 billion. Oh, told you so. Great. So we did it. We made it to the support. Hey. Where do we go after that? Honestly, this is slightly stronger actually than the Bitcoin chart because, realistically, we're touching tips. That would be like another 100 billion, 110 billion carved off the market cap. Does it happen? Yeah, probably. Key support though, at least for now. Matic capitulation breakdown, almost to our target, 200 exponential and simple on the weekly. And then we also have the 382 slightly lower at about 20 cents. So we're pretty much there, almost there, getting close. We'll start looking for bullish divergence. We'll start looking for key support off of moving averages and, horizontal fibs as well. Next we have Avalanche. Avalanche trash, broke down from the 0.5, not quite to the 618. We have a decent amount of price history on this. When we switch over to the weekly, we don't actually have a populated 200 moving average yet. When is this chart from? September of 2020. So okay. So 618 seems likely right here. Obviously bears are in control. This is just a complete meltdown. Looks like trash. I mean, there's all these cryptos just look like trash right now. It's like, oh, which you want to dig through the dumpster and find dinner, or do you want to just dine with some Bitcoin? Because that's what I would do. If you want to be in crypto right now, the place to be is in Bitcoin. Arguably, I'm not even going to say it. I refuse to say it. I was going to say arguably in stable coins, but look, people have been asking me literally for this whole year, probably 2 years now, if I stake, if I hold stable coins, whatever. And my argument has always been, if they're paying you 8%, 10%, 20% interest, somewhere in there is some risk that you're not accounting for. People don't pay you 20% interest to borrow your money if they're not doing crazy shit with it, because companies have to make money. So if I'm going to give you 20% on interest on a loan, aka loan shark, I need to make more than 20% interest on the money I borrow from you, because I need to pocket the spread. So if I give you 20%, I better make 21%. That way I'm left with 1%, for free or off of that loan. So if you're getting 20% from a crypto, expect it goes to zero. Just expect that. Because somewhere in there is some counterparty risk that is not being calculated. 20%, come on. I know you guys aren't retarded, but God, crypto space is just full of fucking morons. It's like they found all the stupidest people with no brains, and then they got them all together in the room, and then that's crypto. That's how I look at it. And keep in mind, I love crypto, but damn, is it full of fucking morons. Solana is next, completely melting down. Almost hit our target right here, 382, slightly above it. Complete trash. Looks like it's going much lower. Confirming it's a bear market. I mean, just garbage. All these cryptos are garbage. It's trying to print some bullish divergence, but none of these are going to bottom until Bitcoin bottoms, or at least the majority of them. We don't know which ones are going to randomly just pop up. Algo, trash, lost the key level. Try to push back up, got rejected. Below 618 now. 786 likely next target, 20 cents. Trash. That's another 33% off the top. XRP, the king of trash. Already down below 618. Again, just complete garbage. Next target on XRP, 21 cents to the downside. No signs of strength here. Trying to pick up some momentum, but I mean, let's be real. The XRP cult has been literally dying for years, and it's a fact. We can look at the chart and tell that because we haven't put in a new high yet. So either the people that love XRP have less money to invest, or there's just less people who are interested in XRP. So it's a cult and it's dying. We've seen it happen with all kinds of things. Plenty of cults have died off over time. Plenty of, arguably you could say a church is a cult. Plenty of churches slowly have, declining, attendance, and then eventually the church shuts down. That's XRP. It's got declining attendance. The cult is dying. Too many people drank Kool-Aid, and there was there's nothing in play to make it succeed. You can argue, oh, it's manipulation, the SEC's mean, whatever you want. But, I mean, the charts don't lie. XRP is garbage. ADA, Cardano beads, Chucky coin. It's at the 382. It's holding up better than most as of late, as it's not just putting in new lows. Everything else is just like putting in new lows right here. Cardano's just hanging on. So maybe the Cardano cult is just putting in a floor at 48 cents. I think more realistically, it's just a matter before the next capitulation event. So Cardano boys, get ready to lose 50% of your value as Cardano moves down to the 0.5 fib retracement of 23.83 cents. Cardano's trash. It's one of the trashiest. And Charles is a liar and a fool. KNC, Kyber Network, at some key support, came down here, put in a new low or retested the low, whatever, at the 786. This is a pretty strong support right here. I would expect this to hold up. It has held up countless times right here. But the, basically like blow off top that we saw just tells you like, you don't want anything to do with this. There's no reason this should have went from putting in a new all-time high on April 27th to being down 80%. There's no excuse for that. This is obviously trash. Hex, obviously trash. Capitulating, new low. Headed down here to our measure move target 618. So 2.3 cents, probably a nice buying opportunity on Hex. Or it just goes to zero and you lose everything. I'd say it's a coin toss. It's probably 60-40 that it doesn't go to zero. Waves at the 0.5 perfectly. This thing is reacting very, very nicely to key Fibonacci levels. Breakdown from here. Now we do see again bullish divergence showing up, so we can see the market starting to show signs of exhaustion, not just crypto but in general. So maybe we see, depending how today's close ends on the stock market and futures, likely if we close at the lows, we know what that means. We didn't run as sellers, we run out of time. So likely we see continuation on Monday, and then maybe we can see a turnaround Tuesday or something like that. Have a nice little week or two of rallying. Don't want to get too excited for it though, because we literally were at these levels, we rallied, we're back at these levels. So are we going to rally again from the same place? Probably not, because it didn't work last time and then we round tripped it. So people are probably just going to expect price to go lower. So waves probably going to $2.16. Does it bounce up to $7.83 first? Probably. It probably does. We'll see though. If this holds, bullish divergence keeps printing, markets start looking like they're bottoming, there's probably a scalp in play on this bad mamma jamma. And keep in mind, please, that just because I look at a crypto does not mean it's good or I believe in it or anything like that. Matter of fact, I think I'm pretty clear about how I feel about most of these crypto projects. This one in particular, I don't know what it is. I don't know anything about it, and I don't really care. But that being said, that is our cryptos for today. And then we just want to take a look at our commodity sector as well. So we see gold had a nice little rally up here as yields and the DXY started showing some weakness. Came back up, retesting 200 exponential and simple. Nothing has changed for me. This chart still does not look good. People are like, even like the hardcore gold bugs are starting to like lose hope in gold. We have confirmed back down the 821 cross to the downside on the weekly. Not good. If we do this long enough, we're going to revisit the lows of like 1700 and test the 200 exponential and simple. And again, just like I was talking about the capitulation move on Bitcoin and how it looked exactly like 2018, right before we went from 6K to 3K, when we went from 38K to 20K, which obviously I was right on, it looks the same way on gold. Gold looks exactly like it did in 2011. Basically cross back to the upside, puts in like a topping formation, then starts to lose the 821 cross again. We consolidate. We have a big drawdown back to support, which would again be somewhere around like that 1700 range. And then eventually, chart speaks for itself. I'm macro very bullish on gold way into the future. But right now, it doesn't look good. And then we look at silver, it's trash. It's consolidating below support. It's failing to come up here and, reclaim those support levels below 200 exponential and simple. I mean, it looks like it is literally ready to just completely fall out of bed. The only thing holding up right now, 200 exponential, 200 simple, slightly lower at 20 bucks. If we lose $20.40, I fully expect either the measure moves to play out or just a retrace to the internal fib, which could be as low as like $17.56. So does it look like this though? Like just a crazy couple week capitulation wick? Probably doesn't stay down at those prices for long. But I mean, it looks nasty. Silver chart looks nasty. Gold silver ratio confirming into a bull market. I do expect this to go much, much higher, telling us that gold's going to gain value in relation to silver. ACB got that breakdown to our fib level, broke down slightly below it. We're looking for the 1.618 at about $1.40. We're about $1.35 right now. If there's value in this thing, it doesn't matter where we get it at this point in time. There's either value in this and it goes exponentially to the upside or it goes to zero. I mean, that's, this is about as beat up as it can get. Doesn't mean it can't go down another 50%, but I look at this straight up, simple as possible. If we go down to zero, we lose 100%. If we eventually return to, one of these other key levels, we're potentially gaining, exponentially more than that. So we're talking about like 10 and 20 to 1 risk reward ratios. I'll take it. Every one of them can go to zero. And if one of them succeeds out of 20, you're still profitable with this risk reward ratios that we have in play. So Tilray made a very, very clear point at the time about why it was so important to take profits on this position, as I did expect lower prices. We rallied up 50% in like 3 days, took profits at the 618, and then after that capitulated to much lower lows. So, we took that entry at 559. We took profits up here at 858, and we're now at $3.28. So if you didn't sell at 858, you got, 60% since then. So again, chart looks terrible. We're not trying to like pick the bottom here. As a matter of fact, I'd like to see a new all-time low below $2.50 on Tilray. That's where it just gets extra steamy and juicy for me, and I want to just sink my teeth into it. But that being said, it's the same type of thing. I don't know if this thing ever goes back to all-time highs. I would assume it does. It's a legitimate business, or about as close to a legitimate business as a drug dealer can be. But, $300 was the previous all-time high. That's 100x from where we're at right now. So do we go to zero? Probably. Do we go to, 100x? I would say there's a good possibility as well. So which one is it going to be? Well, we don't know. I would say there's a good possibility Tilray does not go bankrupt. Maybe it doesn't go to 300 though. Maybe not anytime soon. But, does it go to 50? Does it go to 32? Because that's a 10x. So again, if it's all or nothing, you buy a Tilray right now for $3.27. It goes to zero, you're out $3.27. It goes to $32.70, it doubles. It goes to $300, or I'm sorry, it 10x's. It goes to $300, that's 100x. So, I mean, that's all there is to it. It goes to zero, or, it 10/100x's. I'm okay with either one. Obviously, we'd prefer the 100x. Hexo, same thing. This thing is just completely melting down. I honestly am not sure exactly what's going on with this. I know Tilray like did a loan or you know recently to them, and now there's talks of a potential buyout. Really not sure what's going on with this. Same thing. You know, it could go to zero. It's at 20 cents right now, so it's not far away from zero. I know people were like talking about they were worried about it getting delisted at like 60 cents. I'm like, I wouldn't be worried about that at the time. We'll see in the future. I mean, I don't know. We'll see with this one. I mean, you know, obviously the smaller cap ones, this is very small cap. The smaller cap ones are obviously much more risky. But again, you know, the upside risk reward is exponentially more than that. And this is what we're looking for. We're literally, this is our favorite kind of chart right here. When we see something that's completely capitulated, but it's a legitimate actual business and there's potential it could succeed in the future, it's at 20 cents. You know, a return to the last peak high right here, that's $11. The previous all-time high is $34. So again, I mean, we're talking about 10xing is back to $2. So not that unrealistic to think we retest our breakdown support as resistance. And then, you know, previous peak right here, 50x. All-time high, 150x. So if I told you, hey, you want to bet on this coin toss, it either goes to zero or, you know, heads or tails. And you say, I don't know, what's the odds you're going to give me? I say, I'll give you 150 to 1. You either lose your dollar or at 150 X's if you're right. We're like, I don't know. I mean, that seems like pretty good odds, to me at least. But again, count it as a zero until it's not. CGC, Canopy Growth, this one has a little bit more of a price history. So, you know, it's not at lows. It is very close to revisiting lows. I think somewhere around like $3 is probably where I'm looking for some kind of entry. That is the previous top from right here. It's also the 1.618 Fibonacci extension from the move from $20 up to the top at like $60. And we were talking about this a long time ago. I know I haven't put this one up on the screen recently, but this is the Eve, this is the Atom, this is the neckline, and we have an Adam and Eve distribution topping pattern, and now we've broken down from the neckline, and we're seeing full-on capitulation. And typically what we're looking for is a measure move from the top of the, you know, double top to the bottom of the neckline. So, you know, where are we looking at? I mean, probably somewhere down here in like the you know, 250, maybe $1.60, maybe a new low. I'm less inclined to buy this one because it's not putting in new lows yet, which is kind of like counterintuitive because you want to like buy something when it's extremely cheap and it's not the cheapest it's ever been, but it's actually holding up a little better. So like technically or fundamentally, it's a little bit stronger than the other ones. But we have to see. I mean, I don't know. I don't know if it stops at 286. I don't know if it stops at 243. I don't know if it stops at $1.65. I don't know if it goes, you know, sub $1. But again, same type of thing. I mean, this thing topped out at $59, $60, and it's trading at $3 right now. So 20 to 1. You know, there's definitely some potential here. But you don't want to be the guy who was like, well, it's at 10 now, and it was at 60 before, so that's 6 to 1. Might as well, right? I mean, you can. 6 to 1's not terrible. Counter trend trade, trying to just pick a bottom though. I'd rather something like 20 or 50 or 100 to 1. I like my odds a little better with those. But pot stocks are just getting absolutely hammered, and I would expect them to continue getting hammered. But one day they'll be, you know, the jewel of everyone's portfolio. The truth is, they wouldn't be looking so nasty on the charts if everybody didn't just give up on them. I mean, you don't hear anyone talking about pot stocks, and that's when things look juicy, when nobody's paying attention. All right, so URA. So we're seeing the uranium space basically just do exactly what I said. We came back up. We got the retest of the 200 exponential and simple. We're confirming into a bear market. We're retesting the lows, and it looks likely that we break down from here. We do have a target for potential trade setup around the 382, or realistically, where we're trying to really load up on this is the internal 5 or the macro around like $14 to $15 is where I'm looking to load up on uranium. And again, this is going to tell you too, this is very similar to, you know, confirmation into a bull market. We basically went parabolic as soon as we crossed above the 200 exponential and simple, flipped the slope over blue, and now we're seeing the reversion of the mean play. back to the 200 exponential, the retest of the 200 simple is right around where we're trying to get an entry at. So we don't want to get greedy here looking for $14 and then it comes to 16. We don't end up in the trade and then it goes parabolic. But what I see happening on URA or uranium in general is basically an internal 5-wave right here that makes up the 1 and then a retracement of that 1, which would potentially bring us to our target right here where we would be buying support. And then after that, another leg to the upside, which would give us our 3, and then of course a 4 retracement, and then a 5. Maybe return to all-time highs, maybe just back to 786. Who knows? I think realistically though, the next macro upside target is going to be like $42.73. So if we can get it around, $14, $15, $16, we're talking about almost like a 3x on this. And I do feel like uranium is going to be a 10 to 30 year trade. I don't look at this as just some quick little scalp. I mean, it's cool to scalp and take some trades in the meantime, but I really think that it's gonna be the type of thing that develops into like a 30-year position. UEC holding up a little bit better. Again though, looking like it's ready for our next little drawdown here. And again, at some pretty key support levels, do not want to see this thing break down below the 236. 236 probably is our target, around like $2.73. Could see it get as low as $2, and I wouldn't be surprised though. But again, when we kind of zoom out and look at our longer term, we look at our longer term, we're retesting the 821 right here. It's acting as basically like this ascending support. And then obviously, we're seeing what looks like a third push up here and potential top. So we'll see what it looks like. On the monthly, it's starting to look pretty toppy, a little weak. On the weekly, a retest of somewhere around like 230 to like $2 seems likely. And then again, that's going to give us our confidence we want with our targets on UEC. UROY looks much, much worse. Uranium Royalty Corp likely see a further downside. Obviously, beautiful trade setup right there. Played out nicely. Nice little 30% upside. Now we're at new lows. So good thing you took profits, obviously. Next target to downside would be the 0.5, about $1.86. Then we'll have to reevaluate. Energy Fuel Inc. Again, bear market confirmed. Weekly breaking down, retested 200 exponential, 200 simple, slightly lower, about $4. Probably want to get an entry somewhere around there. If we get down here a little lower, we could potentially get an entry around like $3.25. Don't want to get too greedy though. Below like 464 starts to look good. We did see obviously some bearish divergence led to that top, and this one has been underperforming as far as uranium, so I would expect it to overperform to the downside. Altria Group, MO. So we broke down from that ascending support line, came down and all but touched our fib level. So we're below support, but we're at our horizontal. We still have technically a higher low, so it looks okay for now. Again, this is one that on the macro looks really juicy, but short term doesn't look so great. We basically were expecting a retest of a 200 exponential and simple. We got the retest of 200 exponential and simple, and then we got another leg down after that. So that's why we don't want to just set these targets and then say as soon as they get hit, we're just immediately a buyer. We want to look for what the price is telling us, what's going on. And again, we see it was very easy to pick the top on MO as, basically we saw the sell by sell signal, the divergence signal, bearish divergence at the top of the range. And that was obviously our top. And since then, I mean, it looks like a lot more on the chart than it is, but a quick little 22% down in about a week. Pretty juicy. Pretty juicy. Now, is this going to end up being an amazing buying opportunity? I think it will, but we don't want to jump in too soon because we could come down here on the monthly and actually get a little closer to like $40, another like 12% downside or something. That would look like the entry that I want. But again, this looks like there's potential for continuation, but this could easily develop into a topping pattern. And then all of a sudden, everything changes. The macro changes, whether or not we want to be in that trade changes. KHC, Kraft Heinz. So we talked about this, how it needed to hold this support level. We got back up to it, been closing below it. And now it's very clear that we're not holding that support level. We are not holding this ascending support or the Fibonacci, and it looks like we're headed down much lower. So again, that's why we didn't want to just jump straight into this trade right here. We talked about how the requirements, what the chart needed to prove to us, what price action had to prove to us before we would enter that trade. And since it didn't do it, we're patiently waiting for our lower price target. We're looking for an entry somewhere around like about $29, $30. At which point in time, this could look super juicy. But obviously, good thing we didn't just jump into that trade recklessly. I mean, it's not like it's down a ton since then, but definitely potential for this still playing out long term. Got to just be a little patient with this. CBT, Cabot Corp, saw that big capitulation. Basically a retest of 200 exponential and simple. No surprise. That's what we were expecting. We got the hard sell signal. We left the bullish control zone. Looked like at least short term top. Doesn't have to be like a macro top, but maybe it is. If it is, we're going to start paying attention to these Fibonacci's, and we'll be validated once we hit the 236 at $57.10. So there's our next target to downside, $57.10. Don't expect that will be the macro bottom, but I would expect at least a reaction reflex rally off of that level to a new lower high. More likely than not. HUSA, Houston American Energy Corporation. The hell were we doing here? Oh, okay. We talked about this continuation potential trade, and I think this is the cross on the. Oh, okay. What was that? The weekly cross? Okay, yeah. So that was the weekly breakdown from the 200 exponential and simple into the bear market at like 118 back in 2012, and now here we're confirming into a bull market for the first time in 10 years. At like the break above $3. So that was obviously when we want to be really bearish on this. This is obviously when we start getting bullish on this. Now it doesn't mean it doesn't have further drawdown, but this thing's looking pretty juicy right now. So obviously came up to the 382, saw a temporary top. So we see it's trading fairly technically, a retest of 0.5, a retest of the 382, support at the 236, 200 exponential and simple. I would expect this to consolidate around for a little bit. But realistically, what were we talking about with this trade setup? Oh, okay. I think we were talking about how we wanted to get it closer to the 236 because the stop loss on this would be like 53% before we can technically invalidate, and our target's only 400%. So while it is an 8-to-1 risk-reward ratio, the trade setup is good. The probability of winning on this is good. Basically a coin toss at this point in time. But the drawdown is so much that people will say, well, I'm not going to set a 53% stop loss. That's horrible. And we're talking about how you can use your position size to calculate risk. So essentially, if we wanted to take a $100 position in this, if we wanted to risk $100 in this with a 53% drawdown, we would basically need to take roughly a $200 position. So if we're right, the $200 would, basically turn into like $800. If we're wrong, the $200 turns into $100. So we're risking $100 to make $800 basically, using that simple calculation, that simple formula. Me personally, I don't like using like 50% drawdown stop losses and stuff like that. Doesn't mean that they can't still be viable. So, but overall, this thing looks insane. This is a crazy wick and everything, but this is sort of what happens when you go from a 10-year bear market into a bull market. It goes parabolic. Could that be a short squeeze? Is this the meme stock? Whatever. If it was anything but energy, I would say probably, as it's been putting in new lows for like 10 years straight and then just goes parabolic. But it makes sense that an energy company right now would like suddenly all of a sudden be killing it. I don't know what their financials look like. I didn't look at the fundamentals, but they're probably pretty damn good right now after like a decade of losing money, or at least a large chunk of that decade of losing money. So ENI is next. So we did see that breakdown below 200 exponential and simple. We're close to the 236. That's what we're looking for a macro confirmation of basically our low back here in 2020 to our recent peak. Losing the 200 exponential and simple is not good. Obviously, confirming the 236 tells us that we can start fibbing and that the macro is probably in, at least short term. We would expect some kind of retest of a 200 exponential and simple, maybe up to like 1280 or something like that. But eventually we do expect lower lows, probably to around this 382 level, around like $10 and maybe 50 cents or something like that. There's a bunch of consolidation and support around that level already. So I think that would probably be a viable support. And that's where we would be looking for an entry. I don't think you're going to get let's say it came down here, hit the 236, and then immediately got the retest, 8%. I mean, that's not even worth getting out of bed for. Realistically, what we're looking for is a retest of like the 382, and then the bounce to the 236, or the reversion to the mean retest of a 200 exponential and simple. So, we want to wait, be patient for it to come to the 382. We want to look for some key levels if we start breaking down below for a stop loss, and then we want to look for like key targets back to the upside. So here we can get about, roughly a 3-to-1 risk reward ratio with the target at 236, an entry at the 382, and a stop loss basically if we start to lose some of these recent supports. So, all right. We did it. Yeah. We made it to the end. We looked at all these assets, man. We did fail on one thing, though. Having a short stream. 2 hours and 30 minutes, not short. But it is a weekly wrap up. We did skip commodities. I did rant quite a bit as well. So, it is what it is. They can't all be winners. All right. All right. So all right, so we're going to wrap up with oil. So I have WTI crude, West Texas Intermediate crude oil cash. I mean, you can look at any of these, but essentially what we're looking at is, we peaked right here. We try to retest that peak. We technically have put in a lower high on the daily. We're below the 821. It is crossing to downside. We have a nasty, nasty red candle right here. And it looks like we are getting ready to come down here and retest the 200 exponential and simple. What drawing tools? So we're at the 236 right now. If we go from the low from December of 2021, so we have basically confirmed that this is at least a, swing low and swing high. If we do a reverse fib right here from the high to the low right there, we will actually see, I'll turn this one yellow. We'll see when we came back up, we got an internal retracement of roughly 78.6 or 88.6%. But we have printed at this point in time a lower high. Seems likely we come down, support at the 236, obviously. Seems likely we're going to head back down to the 382 around 96 though, which probably lines up with the 200 exponential and simple when we get there. Obviously we've been talking about spike high in energy and oil, in nat gas, all this stuff. We're seeing it play out in real time. Again, we don't like to try to pick the tops. I mean, obviously my price target to the upside was 114 and 120. I mean, we nailed that. We actually blew through 120 depending on which oil you're looking at. But I think we're topped for right now. I really do. I mean, and the chart's starting to say the same thing as well. So, yeah, we'll see. On the see, I don't like that. On the weekly, this peak right here and this peak right here are basically the same. It's basically a double top and then a nasty bearish candle right afterwards. And then here, we see obviously a peak up here at 8.5, and then we see our next peak was at 7.5. And then here on the stochastics, we see our peak was here at 91, and we haven't technically peaked yet, but it's rolling over at 63. So we're, and then even the knife is showing bearish divergence. So we're basically seeing, bearish divergence taking place from what amounts to a double top. So it does look like we're going to see a deeper retracement. We are obviously at key support right now, but it does look like we're going to see continuation. And I'm going to tell you right now, because everybody is crowded into the energy trade, because everybody and their mother is in energy right now, in oil, in nat gas. Everybody's sure that everything's going to cost more in the future. There's going to be massive inflation. Oil is going to be so expensive. There's not enough energy. It's just going to keep going up. It's definitely not going to kill any demand. the cure for higher prices is definitely not higher prices. Those last two comments were obviously sarcastic. So everybody's going to be in this trade. So then if the trade turns, everybody's going to be on the wrong side of the trade. Therefore, we see increased volatility. And when I say increased volatility, I mean to the downside. So if all of a sudden we start seeing heavy selling coming in on oil or energy, expect that a bunch of people are going to get caught with their pants down, and not in a good way. So what do I expect? Well, I mean, if this starts topping out, it's going to get nasty. I expect big swings. Maybe we get a nice bounce back up. Then we get a, capitulation to the downside. Maybe we get a capitulation to the downside, then a nice bounce back up. But I would expect big swings in energy. Big swings. But not looking good right now, obviously. It's been looking good. It's been the trade of the year. Obviously have taken advantage of energy, commodities, all this good, juicy stuff. But the fact of the matter is, we don't need to be the last guy up taking shots at the party. It's okay to, find a pretty girl and go ahead and leave before everyone else does. They can tell us, what it was like when the cops showed up later. Because that's what this looks like. It looks like there's a party going on, and it looks like the cops are showing up right now, getting ready to bust in that door and take everybody to jail. So, and that's what happens when the market is constantly smoking crack. The cops show up and take you to jail. But we did it. We made it to the end. Yeah, hooray. Everybody made it. We made it, guys. Yeah. I'm going to jump back in chat real quick, and then we're going to wrap up the stream and get the fuck out of here. Thank God it's Friday. Yes. All right. So let me see where I left off here. Where are the bots at? It's kind of lonely in here today. I'm just kidding. Fuck the bots. So Parag says, what's happening, everyone? What's up, man? Good to see you. Jay Hoff, do you ever look at THCX cannabis ETF? I do, man. I do. But it's like, it's the same thing. I mean, I can't remember exactly what's in THCX, but it's like all the same ones. It's either the two main ones I look at are YOLO and THCX. And I may even have like a leftover. I think I have a leftover position in both of those from when I took profits and didn't just like sell out the whole position. I just left some of the profits in there. And I'm pretty sure they're down like 75% or something ridiculous. So there's definitely an argument to be made for just not keeping your profits in, a stock or a crypto. But also it's the market's money. So the market gave me a bunch of money, and then the money went down by 75%. So in hindsight, should I have just sold the whole position? Sure. But I just build positions over time like that. I do the same thing in altcoins. When I trade altcoins, say I have a quick pop in an altcoin and I make, a quick little 20% move or something like that. I usually will take back out my principal. I will usually take half of the profits out as well. And then I might leave like 10% of those profits, or 50% of the profits, or 10% of that move. I might just leave that and just forget about it. Because it's not my money. It's the market's money. It just donated it to me because, they don't know how to trade or whatever. So, but I'm pretty sure THCX and YOLO are both down like 75% from the last time I messed with them. And I'm pretty sure that the breakdown on them is basically like large portions in, I mean, I could look, but I'm not going to. But I'm pretty sure they have big positions in like Aurora Cannabis, Tilray, Sundial, Canopy Growth. There's like a couple other ones too, but it's pretty much the same thing. I mean, the whole space looks like trash. Obviously, it's just a matter of like which one looks worse, I think. But when they're going back up, those will probably kill it. And I do like the diversity. I think it's in THCX X where they have like what is it? I'm pretty sure they have like all aspects of it. They don't just have like cannabis, like whatever they call them, where people go and buy it. What is it? I can't think of the name. I can't think of the name of it, but it's like where they go and get their quote unquote prescription to their drugs. Drugs are bad. But they have like everything from the actual like retail locations and retail products to like all the way down to like farmers that are growing it, like fertilizer companies, like just they have like everything in there. Of course, they should do better with fertilizer companies in there, but somehow they've still gotten destroyed. Dispensary, that's it. Thank you, my friend. Not a hard word, but every once in a while, my age gets to me for sure. All right, so Sohail says, something in a foreign language. Mille grazie. I don't know. So maybe like thank you. Parag says, do we cover gold? Yeah, we looked at gold. It looks terrible. I mean, it's just doing nothing. It's going sideways forever. But I looked at it. It's just at the 200 exponential and simple. So it's not undervalued. It's not overvalued. It's right there at fair valuation. And obviously, we're trying to buy things when they're undervalued and sell them when they're overvalued. So there's nothing really to do here for me. Now, obviously, I always have a gold and silver position. Always. So no matter how much trash I talk about metals, I'm right there with you. Prague says, sexy bot on vacation. Yeah, it looks like it. And Jay Hoff. So yeah, that's it. All right. So appreciate everybody who tuned in today. Hopefully y'all enjoyed the stream. Obviously going to go ahead and wrap it up there. Going to be a crazy week in the markets. Monday, we are not going to see the markets open in the United States for Woke Day. And then, so yeah, that's a holiday. So what, we'll have our stream on Sunday from 8 p.m. till 9 or 10. And then Wednesday as well from 8 p.m. till 9 to 10. And then, of course, every Friday from 11 a.m. till... What time is it now? Damn, 1:43. So we went about 3 hours. Long stream. But it is what it is. Went in depth. Got some rants, all that good stuff. So go ahead and wrap it up there. Everybody protect yourself. Obviously, depending on how the markets close today, if we're seeing closes at lows, we know that we would expect continuation into the week. If we're seeing like a little bit of strength right here, at least it looks a little bit better. So we'll see what happens in the next 2 hours. Expect the market to try to push back up here over the next couple of hours. The stock market is inherently bullish all the time. It's supposed to go up. It's literally engineered to go up. So always expect that even when the bears are in control, the bulls are always going to try to take back control. And that's the opposite with crypto. There's nobody trying to save crypto. Maybe Michael Saylor, but the Fed doesn't care. It's a small asset class. No one cares about crypto. Everyone cares about stocks, obviously. So going to try to rally back up here. We'll see. The best thing we can do is close off of the lows and then get some strength in the next week. I think we're more like, we're literally putting in new lows every day. So trying to pick the low is like, oh, I picked the low yesterday. And you're like, yeah, you did. You're right, man. And then it's like today, it's like, oh, I picked the low again today. So if we just keep putting in lower, low, lower, low, lower, low, lower, low, you're never going to pick the low, or you're going to pick it and then we just put in a new low. So then, did you really pick the low? No, because there's a new one tomorrow. So not really looking to get bullish on these things, but we are seeing a bunch of stuff at key support levels, trying to grind in at least like some temporary bottoms. So we're definitely looking for some nice scalp trades. And I'm sure there'll be some good ones in crypto over the weekend if we do find some kind of support. So yeah, let's go ahead and wrap it up there. Everybody have a great weekend, and we'll catch you on the next one. That is it for today. It is 1:45 p.m. Eastern Standard Time on Friday, 6/17/2022. I am Crypto Trend Trader, and I am getting the fuck out of here. Everybody have a great weekend. Thank goodness it's Friday. Peace.